it was from January to, I'd say, June. I was just like the average person, just like trading during the day and stuff like that. And then around June to December is when it shifted to like, okay, if I'm going to really do this, I'm going to start acting like I'm a real trader. So I started waking up at 4 o'clock every morning because I'm on the West Coast. So I wanted to see what it would be like if I was trading New York hours. So I'd wake up 4 o'clock in the morning, get to Starbucks by 4:30, and I would pretend like I'm a real trader. So even though I'm just trading on like a mini account and a demo account, I'm going through the process of what it's being in that mental state that, oh yeah, I'm a real trader. I got to do this. I got to really focus and be engaged with the trading process and learning how to trade while I'm going at it.
Okay. And how come you had to go to Starbucks each morning? Were you trading from Starbucks?
Yeah, I like going to Starbucks because being home, trading from home, it wasn't the same. Like if I'm trading from home, I'll just end up closing my eyes and going back to sleep, or I'll lay down or take too many breaks. So
Okay. And Starbucks didn't kick you out at any point?
No.
Okay. So while you're doing this is still part-time at this point, yeah?
Yeah. Part-time for a long time.
Okay. And the year is 2018 at this point?
Mm-hmm.
Okay. So you went full-time, when was that? At the beginning of 2019?
Yeah, January 2nd is when I decided to go full-time.
Okay. Tell me about that. What gave you the confidence to go full-time, and how do you feel like you prepared to go full-time?
So what gave me the confidence was December of 2018. I was really comfortable with my trades. Like, yeah, I wasn't making a lot of money because my leverage wasn't there. But just prior to that, yeah, I was learning. I felt like I was like one with the market, if you want to call it that. But yeah, so on January 2nd was my first trade. And the price was getting to resistance, and I just went in pretty heavy on that trade. And then within half an hour, I made like $1,500, and I could have made more, but my favorite number is 15. So like I saw $1,500. That's the most money I've ever made on a trade. So I was like, oh, I'm going to take that and run. So from that point, I was like, okay, I just made $1,500 in half an hour. I think I could do this full time now.
And what did you have in the way of starting capital at this point, and also savings set aside?
Savings, I had a good amount saved up. I think I had like $5,000 saved up, but I had 20,000 in my trading account. It's all saved up from Lyft and a couple of loans.
Okay. You didn't take out loans to fund this going full time?
Well, I just talked to my mom. Like I talked to my mom and my dad. My dad was the one that encouraged my mom to give me money because my dad saw what I was doing, and then he saw the progress I was making. So he got my mom into giving me money to help me with my trading. Yeah.
Okay. So you had $5,000 in savings. I mean, it's not much of a safety blanket to fall back on.
Yeah, it's not.
And so how did you go once you started trading full time? Did you notice any difference, like psychologically?
Oh yeah, it wasn't as that $1,500 wasn't going to be as easy that easy every day for sure.
I'm sure you realized that pretty quickly.
Yeah. But that first month, I made almost $6,000 on my first month, and the fact that I made $6,000 in my head, like, oh, I just made $6,000, and I feel like I could have done better because there was a couple of bad trades in there that I just didn't get out of, that I held on too long, but I mean, I still came out profitable for that first month. So like that next month, like I'm like feeling like I'm invincible. Like me and my girlfriend go to Hawaii. We're staying at the Ritz-Carlton. We're like eating at all the places we want. And like at that point, I was like I was overconfident in my trading ability
Yeah.
for only my first month.
Yeah, because 2018, just to put things into perspective here, that wasn't like a home run year for you. That was your first year attempting this trading thing. And I
Yeah,
think your
that was
P&L,
just on
like
a
you,
demo.
okay, there was some live trades in 2018 though.
Yeah, but they're all like unleveraged accounts. Because one of the guys you interviewed on your podcast was saying to trade unleveraged. So I traded unleveraged for a couple months, and then as I was progressing, I would increase my leverage, and then once January 2nd hit, that's when I like really upped my leverage.
Okay. I'm going to make a note because we'll circle back to that point. Leverage is something I'd like to talk to you about.
Mm-hmm.
What about misconceptions? Were there any misconceptions or realizations that soon hit you once you began to trade full time? What were some of the things that were unexpected?
The psychology part. Like, I mean, everybody talks about psychology and everything, and how you have to like somewhat master psychology in trading. And to me, that wasn't something that I realized I needed to learn that much. So, like learning psychology and how I react to when I'm in a drawdown, how I react to when I'm in a winning trade and whatnot.
So, can you share a little more detail on that? Like, in what ways did it affect you? Obviously, you felt bad, I'd imagine, when things weren't going your way. But how was that reflected in your trading?
Just the psychology, like example, when I'm in a drawdown, sometimes I would trade with a stop loss. When I trade with a stop loss, my stop loss will get hit, and then it goes back in my direction, and I'm like, dang, like you get frustrated, and then uh, your trading plan pretty much goes out the window because of it hit your stop loss, and then mentally you're thinking different things. But if I originally stuck to my plan, then it would have been a lot smoother.
Today, you've now been trading 12 months full time.
Mm-hmm.
Do you feel as though that part of it has become a little less difficult, or you feel a little more prepared psychologically for these periods where things don't go your way? And do you find that you deal with them a little differently now, or is that something you're still working on?
Well, the frustration part is handled pretty well. Like, I don't get frustrated, like I don't get angry or anything when I'm in a bad trade. So that's fine. It's like psychologically, mentally, like my head, if I lose, then that's more of just a setback. Okay, just how can I learn from that and keep going without having it put me down?
Okay. There must still be days though where it does get the better of you.
Yeah, but not too bad. Like, I try not to put my mind in that kind of state.
If someone listening to this is really caught up on the psychological aspect of it and gets frustrated with things when they're not going their way, which is very common, do you have any maybe tips or tricks that helped you to become a little bit more comfortable with this?
Put your mind on something else for the short time being, because with training, for me, it's like you want that instant gratification of making money right then and there. But if you can divert your attention to something else, like for me, I have a Rubik's Cube, and it took me forever to learn how to do the Rubik's Cube. Now, like if I get in a trade and I don't want to look at the charts because it's green, I'll distract myself with doing the Rubik's Cube. Like I'll mix it up. I'll do the Rubik's Cube in different orders, different colors, or I'll do it one-handed, just something so I get my mind off the charts so I can let my winners run. Because typically, when I try to let my winners run, they don't. and or I'll get out of them too fast, and then like when I get out is when they keep running. So if I distract myself, I feel like that's a good way to get your attention somewhere else, so you're not fully engaged.
Right. So if I understand correctly, in a way, you're saying that for you, it's better if you're not micromanaging the trade, watching it tick by tick almost.
Yeah. Because sometimes I'll tend to do that, especially like when the fundamental releases come out. I'll be too engaged, and I'll either take profits too quick or vice versa. And if I can just distract myself by doing the Rubik's Cube, I can't look at the charts until I finish the Rubik's Cube. That's just enough time that I can let the trade breathe, as they say.
Okay. And more importantly, how quickly can you solve the Rubik's Cube?
Maybe like 2 minutes, not even 2 minutes. Just depends on.
That's impressive.
Yeah.
Nice.
But I mean, it took forever to learn how to do it. It's just now I can do it pretty easily. Like now I'm trying to challenge myself. Can I do it with my left hand? Because I'm right-handed. So if I could do it left-handed only, like how hard is it to do?
Right.
So yeah.
Mad skills. So 2019's just come to an end, which marks your first year of full-time trading. What was your P&L for those 12 months?
So total, I think it was a little around. I think it was around 25. I don't know the exact number, but it was around 25. But my first 8 months, it was all good. Like I think I made almost 30 from January to August, and then September, October is when I really hit the wall.
What happened during those months? And what do you mean by hit the wall? Like what happened?
I didn't blow my account, but I mean, I lost maybe 12,000 total between September and October. So, but September I lost about 2,000, and then October was about 10,000 that I lost.
Okay, so how come you were green each month, which is very good, by the way? Especially for your first year going at this full time, how come you were green each month up till September, and then you had two pretty significant, well, not significant, but the losses were probably a little bit more than you would have liked to have lost.
Yeah, for sure.
What led to those losses?
So September, I was just in the wrong direction, for one, of course. But I was, I didn't have a stop loss, and I was just holding my position. But because typically, I'll be in a trade, but I'll be in the trade small. And if it goes red, I'll keep it, but I'll keep it there. And when I see it's about to come back up, that's when I'll increase my position size a lot more, and that's when my profit comes. Right. So I'll scale in basically, and those times that I scaled in were the times that it didn't go my way. So I was in a double drawdown, and then so I didn't make any money in September, and then October, which was kind of it was more of the situation I was in, is because me and my girlfriend, we went on vacation to Mexico. So in Mexico, I don't have internet. So I was in trades while I'm in Mexico, and I don't have internet. And when I had internet, I would trade. Example, the one trade, I reversed my trade because I was hitting resistance. I reversed it, and it went my way. So I was up like $1,000, but I didn't take it because I guess I was being greedy, so I wanted more. But I didn't put I didn't change my take profit or anything, or up my stop loss. But we left the hotel, and then we went island hopping and snorkeling. And then by the time I got back, it was back at zero. So I got frustrated. I'm like, oh, dang, I should have just took that 1,000 before, but now I'm back at zero. And then I say, okay, maybe it's going back up, and it's going to break resistance. So I switched it, and I thought it was going to break resistance, but it didn't. So I switched it back, and like I wasn't in my normal state of mind, because like if I'm back at home, I have my computers in front of me, I have my charts laid out, I have a plan that I could see, but I'm just trading from my iPad, which was a horrible idea, and just trading what I saw. So I thought price wasn't going to break resistance, so I switched my trade again, but I went to sleep, and then I didn't have my stop loss again, and it ended up breaking resistance too much, and I got margin called out of that trade, and it was a pretty big hit for me.
So it was a whole series of errors.
Yeah.
What's the lesson there?
It wasn't just one trade. The lesson is don't trade while you're on vacation and if you don't have your screens.
Yeah.
But yeah, more is the stop loss. Because for most of the year, I didn't trade with a stop loss because I knew what I was doing. Because I would scale in, but I'd get in a trade, but I'll be in very small. That like if it went 100 points like the other direction, I wouldn't care because it's a small trade to me. And when it's ready to go back in my direction, that's when I'll leverage in way more to make money. But then now after that loss, like it revamped how I look at everything. Like I did not want to experience that kind of drawdown and loss over again, and the frustration of blaming that, oh, because I was on vacation is why I lost all that money. But because I wasn't prepared while I was on vacation is more reason why I lost even more money than I should have originally.
So you're going to be trading next time you go on vacation?
No, for sure not.
Good.
And if I do, I'm going to use a hard stop loss.
Yeah. So just to clarify a little bit of what you're describing here, some people are probably going to listen to this and they're going to say, this guy's like adding to losing positions, which is typically a no-no in most people's books. But I think what you're doing is you're taking a very small kind of starter position, if you will.
Yeah.
And it's all part of your plan that if this moves against you,
it's okay.
Yeah, up to a certain point, I imagine. I imagine you've still got a point where you're like, I'm just totally wrong on this trade. Yeah?
Yeah.
Okay. It is in your plan to allow this position to run against you and add at which
a certain point
you perceive to be a better price.
Yeah.
And begin to move more size on at that point.
Yeah. Because psychology for everybody, like everybody wants to cut their winners, right? And hold on to their losers. So if I have a loser that's small, I'll hold on to it long enough that, okay, I think this is the bottom of that. So if I like 10 times my size, well, not literally, but then like that's when the money comes.
Yeah. You're not all in at one price, full size, hoping that it works right away. Okay.
Yeah.
So how confident are you in your trading abilities currently? Like, where's your head at now? So you've just finished 12 months full time. Your first 9 months or so were really good. Then you had a little bit of a reality check. How do you feel about things currently?
I feel a lot more confident and comfortable. But of course, I know there's a lot more I can learn. But as for psychologically, I'm a lot more prepared. Because right now I don't have a like normal journal. What I would call it is a scouting report. So because I'm like sports based, like when you're playing sports, you want to see your opponent, you want to know what you're going to go up against. So what I do is at the end of each day, right when the candles close, I'll go back on the smaller time frames and I'll analyze what price did that day, where price reacted to, where price needs to get to next to continue a trend, and if it doesn't, then it might reverse at that point.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs. And short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
Now's probably a good point to go into this a bit more. Let's focus in on your actual trading style or your trading approach. So we've obviously discussed a little bit about, how you work your entries into a position. But just what's the overall premise of your strategy? Like, what kind of drives your trading decisions? What sort of things do you look for? Do you seek to take advantage of? Explain that part a little more, if you could.
So I use the main, like the middle of my trading is based off of Fibonacci's and support and resistance. And then I also add on pivot points and oscillators to give me a heads up in what I should do. So, example, if the Fibonacci is at the 61.8 and that's near a pivot point, and also the oscillators are low, then to me, that is a sign that I should go long.
Okay, so you're trying to enter the market at turning points.
Mm-hmm. But sometimes I'll get in at the 38.2 just to test it. If I see a little bit of resistance, I'll test it with a small position. And then typically I'll wait for that to go to the 61.8 or sometimes even 0, depending on how strong I think each level is. And then when I see that it's time to push, that's when I'll get in.
Okay. Now, on this Fibonacci part, how much weight do you actually give to these levels? Like, do you need to see price, come in at one of these levels to the absolute point, or do you give it a little bit of leeway? How do you think about that bit?
So I think of them as zones. So if I set up the Fibonacci's and I'll look at each one, I'll look at the 38.2 and the 50 and the 61.8, mainly those three. and I'll go back before the Fibonacci was made. And if that is a support level, so if there's past support at the 61.8, there's a good chance that that can act as support when it gets to the 61.8. Does that make sense?
It does make sense. How are you drawing or getting these Fibonacci levels?
So for me, I'll have multiple. So I have maybe 3 Fibonacci's. I have one really big one for like the whole year, and one medium-sized one from the last couple of weeks, and then I'll have a small one for like the last couple of days, just so I have an idea of how price is reacting to these levels. And if it does react to a certain price, then okay, this fib is a good one. And if it's a good one, then I'll trade within that Fibonacci.
Okay. Can you tell me a little bit more about your use of multiple time frames here?
When I look at the bigger time frames, that's when I can get an idea of where the trend is going. And then when I break it down to the smaller time frames, I more try to pinpoint certain prices that I think it might react from.
So what's a bigger time frame and what's a smaller time frame? Like
the smallest time frame I'll look at is the 15-minute time frames, because typically if I don't want to hold on to a position for too long, I turn into a scalper. So I'm basically scalping from different zones or key prices that I think price will bounce off of or break through.
Okay, and the bigger time frames you look at, are they kind of a daily time frame, or do you go further out than that?
The main ones that I look at the 15-minute time frame just to see where I can enter at a better price or if I'm scalping. And then the 60-minute time frame, I'll look for stronger support and resistance, and then so on for the 4-hour time frame. The 4-hour time frame, I don't really pay attention too much, but I do look at them just to get an idea if there's something else that might be there that I don't see on the smaller time frames. And then the daily and then the weekly is where I set up my fibs, and depending on the oscillators on the daily is my main source of whether or not I should be bearish or bullish.
What you've spoken about here is several indicators and a very technical based approach. I know volume is a bit of a funny one in the Forex market because it's not entirely accurate. Does volume play a part in your decisions whatsoever?
No, because I don't even know how to read the volume.
Okay.
Do you mean the oscillators or?
No, like the trading volume. So I don't trade Forex personally, but I may be off here, but I think depending on the broker which you trade through, the broker will display some sort of volume for, how much buying and selling is going on at any point in time.
Oh, no, I don't pay attention to that at all.
Okay. But it's a little bit funny because all you're seeing is the volume which comes from your broker and not so much the entire global Forex market, if you know what I mean.
Yeah, it's more of just the oscillators that to help me predict whether I'm going to be bullish or bearish.
Okay. So what do you like about trading the FX market? And have you traded any other products, or was this the first thing you came into?
This is the first and only thing I came into. Well, I explored in the beginning, like I was exploring trading overall. Like I was looking at all the trading that you can do, like from options to equities to pretty much cryptocurrency and everything. But when I fell on the FX market, what really got me engaged was more of, because I used to live in the Philippines. So when I would exchange money, I would see other currencies and those would exchange for more money. And I always thought like, oh, if I bought the pounds with my dollars and then exchange that for pesos, could I make more money? Can I get a better exchange? But because you'd have to pay extra to buy the pounds, it didn't make sense because I'd probably end up with the same amount of money exchanged. So when I found out that you can do that through trading, well, I mean, it's not exactly the same, but it's along the same lines. It sort of made sense to me how the price and the currencies change and how the exchanging works. So that's what got my attention to trading.
So today, what pairs or majors do you predominantly trade? Where's your focus most of the time?
So my focus now is the euro dollar, dollar yen, and the euro pound. So those are the main pairs that I trade, but I pay attention to those pairs within each other. So the euro pound, the euro yen, pound yen, and just all the pairs within those four currencies.
Okay. And what is it about those particular pairs?
It's just the euro dollar is what I've paid most attention to. So like I'm comfortable with the euro dollar. Like the personalities of each currency is what I didn't know I needed to learn because they all act differently to different prices, right? So once I was comfortable learning the euro dollar, then I started trading the dollar yen and so on. Because at first, when I first started, I was trying to trade every pair that I could. And it was too much. Like I was looking at too many things. So I narrowed it down to just one. Or actually, I narrowed it down to a couple, and then I eventually narrowed it down to just one. Because if I could just focus on one, because I'm just a beginner trader, right? So if I just focus on one and be really good at trading that one thing, I can eventually branch out and start trading other things better.
Okay. So you picked one pair and you just focused on that until you got really familiar with it. How long was it until you added another pair that you began to watch?
Maybe
just
not
roughly.
Too long ago. Yeah, like after October, around November, because after that big loss in October, that's when I was thinking like, how can I get better from here? So more opportunities to trade would be better for me versus just waiting on one currency to move, and it would take too long. So if I had more pairs to trade, I felt like I can make more money, especially when I reloaded my capital. Then I was able to trade more pairs.
Okay, so you for those first 9 months or thereabouts, you traded just one pair. Did I understand that correctly?
Yeah.
Wow. Okay. Interesting.
I know I had a couple pairs, or I mean, I know I traded the euro pound a little bit because the volatility was kind of crazy. So I traded that just a little bit, but nothing substantial.
Sure. So there was a few exceptions.
Yeah. But I mean, I mainly for those 8 months was just the euro dollar.
Let's speak about the hours that you trade. So the currency market trades, it's 24 hours a day, 5 days a week. Is it 5 days a week?
Yeah. Well, kind of 6.
Okay.
But yeah.
Yeah. I mean, you would know better than I do.
Yeah.
You work the graveyard shift. How come?
So when I was learning, I was starting at 4 o'clock in the morning. And then also because I'm watching all these videos of psychology and getting better and like keeping myself motivated, there was one video that I was watching and it was Kobe. And I know he just passed away, unfortunately, which was horrible for me because he made a huge impact on my life. But with Kobe, he was talking about you have to outwork your competition, right? So if I'm waking up at 4 o'clock in the morning and trading starts at 5 o'clock in New York, from what they say, it starts at 8 o'clock. That's 5 o'clock my time in New York. I got to get up even earlier. So, you know what? Like, how many people are going to start trading at midnight during the London hours from where I am? So if I can trade from midnight to the end of, or the beginning of the London session to the end of the New York session, I'm going to trade a lot. I know that's overkill, but I'm going to be able to watch it a lot more and learn a lot more within that time frame. So if I'm trading 12 hours a day, that's better than when I was learning only 6 hours a day.
Are you required to, because I'm talking to you now, what is the time where you are? It's like early AM.
Yeah, right now it is, I think, 2:16.
2:16 AM.
In the morning, yeah. And I'm wide awake. And I keep the schedule Monday through Sunday.
So why do you need to trade these hours though? Because the currency market is 24 hours a day. Whereas like the New York is, equity markets kind of have an open and close.
Mm-hmm. Yeah. So when I was analyzing what times the euro dollar or the pairs that I was trading, when the volatility starts, it started around midnight my time until 11 a.m. That's when the price was moving. So I wanted to see how they moved during the London session. So if I could learn how price works during the London session, and then that's one session I'm learning. And then when the New York opens, that's another one that I'm learning. So I'm kind of doubling what I'm learning.
Okay. And because it is a 24-hour market, I might have missed it before. I think you said you're at the screens for about 12 hours a day. Is that right?
I'm next to the screen. I'm not engaged that full 12 hours, of course.
Okay, so about 12 hours a day, you're monitoring it though. You're actively monitoring it.
Okay. 12, yeah.
And then what about the rest of the time? You can switch off, have a sleep, do what you need to do.
So from 12 o'clock to 2 o'clock, I still monitor it, but I'm more relaxing. And then once it closes, that's when I'll do my scouting report and I'll prepare for the next day.
Might be interesting to speak about that. So what does your scouting report look like?
So it's basically what happened that day. So if price reacted at 110, let's say, I'll note that down, that price had trouble breaking through 110, and that is past support. And also that's the 61, it's near the 61.8 of so-and-so. And if it doesn't break through, then there's a chance that it can reverse. And then I'll also note the oscillators are low. So since price is at support, oscillators are low. That's a 61.8. If price can break back up at a certain price point that I set, then if it goes above that, then that's the signal for me to keep going long.
Okay, and how does that help you for the next day? It just you know what levels to be mindful of. Is there anything more to it than that?
It's just mainly watching what I need to watch out for. I need to watch out for this fib or this price because yesterday it had trouble breaking 110. So if it doesn't break 110 today, that means there's a good chance if it breaks yesterday's high, that means that it can possibly keep going up. And if it doesn't close above yesterday's high, then I have to reevaluate what I see.
Now, as you're in the currency markets, I think most of us can agree that it's a very economic kind of news fundamental driven market, right?
Mm-hmm. Yeah.
The currencies can move quite a lot based off world events.
Yeah.
And your trading, as you've described it, is very technical based. So how much are you in tune with economic events?
I use Forex Factory. So with that, now at the beginning of the month, um, I will write down every day for that whole month that has some fundamental news announcement. So I'm ready for when that happens. So if I'm bearish on something, but the fundamental news amount, like example, like interest rates. If interest rates comes out, I know what time that it's gonna come out, and I'm prepared to uh, either if I'm in the trade already to know when I need to get out, or vice versa, or if it's in my favor, then to keep going, let it go.
And what about on a more macro level, like some sort of bigger themes that perhaps are playing out around the world that have an effect on currency markets? Like, are you in tune with that sort of stuff, or you don't give it too much attention?
I don't pay too much attention for like what's going to happen next year, because I'm only concerned what's going to happen within the next couple of days, because I'm more scalping every day. I'm not too worried about the direction, the long-term direction.
Yeah. How long do you hold a position on average? You said you're trading off a 15-minute chart, so I presume it's maybe a few hours. I don't know.
It depends. Just depends on how volatile each day is. Because some pairs they don't move that much, but when they move, they can get going. But it just really depends on how volatile. Because sometimes I can hold for maybe 30 minutes, sometimes a couple hours, sometimes just a couple of minutes.
Okay, so it can vary quite a lot. Do you ever like swing positions, like hold them for a few days at a time?
Yeah, that's when I think that if I'm favoring a position or a direction because of for some reason, I will get in small, and that's when I hold a position for a long time. It's more of that the time that I think that it's going against me, but that's when I'll get in when I think it's going to go back in my direction. Those are the ones that I'll hold a little bit longer than normal.
Sure. Now, without trying to frame you as an expert here, I would like to ask you though, are there any tips specific to FX trading that you would like to share or you think might be helpful for complete newcomers? So things which are specific to FX markets.
Every pair has a personality. Like if you can understand how each pair moves, then I think that would give you a heads up on which pairs you want to trade. Because one, for me, why I stuck with only the euro dollar is because one, it's cheap to trade compared to everything else. The margin's low, and it's not super volatile. It's volatile enough that I can make some money out of it, but not volatile enough that it'll make me go crazy. Because there's the pair that's most volatile to me. I still watch it. That is the pound yen. That one's pretty crazy. But I don't trade it. But I keep an eye out for it, because if I'm ever ready, I know how it acts to certain prices.
Just on this point, specific to FX trading, and you mentioned it right at the beginning. I said we'd come back to it at a later point. Leverage. Trading FX, there are some brokers which provide serious leverage.
Yeah, but I don't think the leverage in America is that crazy. I think it's maybe 50-1, but I don't even trade 50-1.
Okay, so how do you manage the leverage side of it? And of course, that ties in with managing your risk as well.
It's more of just what I'm comfortable with. I'm just comfortable trading up to 5 lots, which is up to $50 per point. So I don't pay too much attention to the leverage just because I know I can trade that. But for when I was starting out, I would suggest to trade unleveraged.
On that note, managing your risk, when you do put on a position, how do you think about how much you're willing to risk on that? And also, just one step further, is there like an ideal risk to reward which you have in your mind?
For my risk to reward is more as long as it's more than 1-to-1, because I do a lot of scalping, so I want to get in at a price where I know, or I'm more confident that I can get something out of it. So if price has been reacting to 110 every time, I'll try to trade 110. I'll trade just enough that I know I can get something out of it, but not crazy enough that if it goes against me, that I'll get wiped out or I'll get frustrated.
One of the things about doing these sort of interviews with newer, less experienced traders, one of the really important parts about doing this, I feel, is hearing about how they are trying to improve moving forward. Like, what are the processes they've got in place, which are going to help to enable them to get better, compared to where they are right now to where they're going to be at the end of 2020, for example.
Mm.
What are some of the deliberate steps and actions that you're taking to improve, to get better?
What I'm doing to get better is more of being more prepared. Example, my scouting report is what I like to call it, and jotting down important fundamentals, knowing when those are going to be released. So if I'm more prepared for that, I know when I shouldn't be trading or where opportunities may be. For example, like I always know when interest rates are coming out, because I know for the most part, when interest rates come out, that's when it can get pretty crazy. What else am I doing? More screens, because before I was just trading on one laptop screen, and I got pretty far with that. And then once I was able to get, now I have two screens, and that allows me to see more. Because like to me, the point of view that two more screens gives me is like, example, a sniper. When a sniper zooms out, right, he can see a lot more. But when the time comes, you can zoom in on one screen and then focus and really get going on that.
And what about in terms of like trading skill? So there you've highlighted being prepared and a little bit of reviewing. Is there anything with regard to your skill and your ability to be able to trade? Is there anything in particular that frustrates you at the moment?
Oh, yeah. Chasing price. Because sometimes when price gets moving for some reason, and I see it, because I have alerts that go off if price gets to a certain point. And then sometimes those alerts will get me going. Like, oh, it's hitting a bunch of these alerts, so price is moving. So I'll end up chasing price. And when I chase price at the wrong time and I don't follow my rules, then that's when I get bit in the butt.
And how about consistency? This is a question I asked to Josh Evans on a previous episode just recently, who's been trading for a little over 12 months now. I asked him, how does he envision consistency to look? Now, obviously, you were quite consistent for your first year. You hit a bit of a rough patch towards the end there, but it looks like you've kind of pulled yourself out of that for the most part. Do you feel like you've reached a point where you can say you're a consistently profitable trader? You know, most people who are new to trading, that's the kind of label that they want to earn.
Mm-hmm.
Do you feel like you've reached that point?
I want to say yeah, but also no. I'm not like fully confident. I'm month in and month out profitable trader. Of course, I've had those 2 bad months, but I don't want to like jinx myself.
Of course.
But yeah, for the most part, I'm comfortable, but I'm not too comfortable that I can just relax, if that makes sense.
Let's just do one last question here. One piece of advice that someone gave you, or if they didn't directly give it to you, that you've heard somewhere or read somewhere that has actually made quite a big difference.
So there's 2 things that that I have in mind that gave me a heads up on what I need to do to get better. First off, it was Kobe saying how he has to outwork my competition. So if I'm going to outwork my competition, how am I going to do that? So more time. And example, when I was at Starbucks and watching YouTube videos, I wasn't just watching it at a normal speed. I learned to be capable of listening to the videos at 2 times speed. So I can watch more videos in the same amount of time the average person would take to watch one. And same with the podcasts. When I listen to podcasts now, I listen to them at 2 times speed because I can listen to more podcasts in less time, right? So that's one thing you have to keep in mind. Like, there's so many people that are trying to do this that you have to outwork them. So what edges or what ways can you manage your time to outwork other people? And then also, another friend was talking about discipline. All the most successful people in the world have one thing in common, for sure, which is discipline, right? So if you have the discipline to wake up at a certain time and do your journal or do your analysis and whatnot without slacking off, even when, or doing it when the times that you don't want to. Like some days, like if I have a bad day, I don't want to do my scouting report because it takes too long, or I'm too tired, or I'm sleepy, or I just want to sleep because I had a bad day. But no, I had to have the discipline to go do my scouting report and reanalyze what happened and learn from it. You have to grow. Like, if you're not willing to grow, then there's no point in learning to trade.
Grow or die.
Yeah. Or like 50 Cent says, get rich or die trying.
Yeah, that consistency part is massive, man. I appreciate you taking the time to do this, Christian, and thank you very much for reaching out, being so open, and sharing your path this far. I wish you plenty of success moving forward, man. If someone wants to find you on Twitter, what is your Twitter handle?
So on Twitter, my handle is Christian with 2 N's _1_. And it's the same thing for Instagram. But I'm not really active on Twitter. Like, I don't really tweet. But I'm on Twitter, but I don't tweet.
Okay. Well, I'm sure there'll be a few people who'd like to follow you after listening to this. So that's probably the best place to do it. Yeah, besides that, you have a pretty low profile presence online, yeah?
Yeah. I'm not really active in the social media world.
Nice.
But I'm active in listening and seeing what other people are doing.
More of an observer.
Yeah.
All right, man. Well, you enjoy the rest of your evening, and we'll chat soon.
All right.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. That affordable commission rebate up to $3,000.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Traders, Aaron Fifield here. Welcome to 190. This is an episode to cover the extreme volatility in markets following the recent outbreak of coronavirus. Joining me is Nishant Purbandawala, returning for a second time on Chat with Traders, and here to discuss how he's been navigating through the turmoil. Nish is a proprietary equities trader at Kirshner Trading Group with well over a decade of experience behind him. Now, just a few things I'd like to point out before we get started. Both Nish and I are sensitive to the fact that there are a lot of people who have been adversely impacted by this outbreak and the market downturn. Nish is here purely to share his insights and wisdom, not to gloat about large gains. Also, you'll hear Nish speak about a scenario for how he thinks the market could play out over the coming weeks and months. It's important to remember, though, he's an intraday trader who's not married to any one idea. He will quickly abandon an opinion when necessary. So as per usual, nothing you hear in this episode or any episode is to be treated as financial advice. You are entirely responsible for your own trading decisions. And after this episode, it would be well worth your while to go back and listen to 170. That's the first time Nish was on Chat with Traders. But right now, here's our latest conversation, recorded immediately after the US close, 18th of March, 2020. Thanks for listening. Pretty much the focus of just catching up with you now was just to talk about what's going on currently, because it's quite unique. So one of the things I was going to ask you about this first of all, and we'll get recording now, when the virus first began spreading through China back in January, did you have any foresight to imagine the knock-on effect that's happening right now?
No, I think like every other person in the United States, no one took this so seriously. You know, we always thought like, yeah, things happen in China, but they won't happen out here, or this won't spread like this. Plus, it's 2020. I mean, really, are we going to die of a virus? Just like the same normal, naive thought that I think every other person had out here. I think we as traders had the same thing. We were just like, oh, great, at least something has come up. There'll be some volatility in the market because of that, and that's it. And, we were just trading like China names and things like that time. And then, I think came February, and suddenly, things started being focused on United States a little bit. A few cases here, a few cases there. A sudden panic in the stock market suddenly started falling like 250 points, and this and that. We're like, oh wow, okay, cool. There's something happening out here, but it's probably an overreaction. People just, there's this. And then one thing we have to understand in this market is that people have been caught with their pants down. When I say that, I mean like everyone was super bullish. Many of these people have not seen what 2008 felt like. So they never they only seen the bull market. And then passive investing, people have just said, you know what, I don't know what to buy. Let's just buy SPY. Let's just buy Qs. So all your 401ks, you're just buying, passive investing, and you didn't have to bother about it because there was no risk management required because the market was just going up every day. No one bothered, your portfolio went from 10% to 50% to 100% up, and no one bothered. And now people keep questioning me like, hey man, my portfolio is down 35%. What should I do? I said, did you think about it when it was up 35%? No, right? So either you don't do anything right now, or you should have done something then, So that's what I tell people. But again, obviously I don't think I had the foresight to see something in the United States.
Yeah, it's very strange because even when it was beginning to spread through China, the market in the US and even Australia here just was continuing to push on into all-time highs just day after day. So I think the majority of people thought that it was going to be much better contained. And as you said, it's obviously caught a lot of people with their pants down. And I think that's partially the reason. Everyone was super bullish up until a few weeks ago.
Yeah, and that's what is different than 2008, right? 2008, we kind of saw things progress over a period of maybe 3, 4, 5 months. Things went from bad to worse to world is coming to an end. In this case, the time period is so much shorter, right? I mean, won't we like nearly at all-time highs in like I think what January, February, pretty much like I think I just saw like 20 trading days ago SPY was at all-time highs. 20 trading days ago. So in that much time, we have sold so much $1 trillion worth of stock. And people, I mean, I would say more people are just covering their longs. They're like just getting out right now, saying that, what, we didn't take any risk. People at the VIX is going crazy because people are hedging the long bets instead of selling stock, at like, crazy prices. I think today I felt, and today is what, today's Wednesday, I think the 17th or so, was the first time I think I saw some buying come in a little bit at the end, but there was a lot of panic. And then some stocks have just done so badly, like they are like down, I don't know, 2008 levels, REITs, anything that has mortgage in them right now. People don't think that debt is the biggest problem. And, I feel like there were like stocks like HYD, IB, what was it? What are the bonds like TLTs and, the TBTs and all the bonds and everything is just melting down. PFF, the preferred ETF, like that's like getting killed. I mean, it got killed back in 2008 also, but that made sense because, it was a debt crisis. But this is turning into a debt crisis. Just watch it because the way America works, and I was telling my friend that, we need to change the mentality of this country, of our community, is that we got to start saving money for a rainy day. It's like 75% of America lives paycheck to paycheck. Now, they live paycheck to paycheck, but they can always save some part of the paycheck. I'm sure there's a certain amount of people that can surely, do that. And now when shit hits the fan like this, everything just goes in disarray. It's like it becomes into a world-ending situation, becomes like into the Walking Dead, which it won't happen. It'll never go that bad, but the fear is going to be that bad, and people will just like sell everything and stay in cash. And that's what happened in 2008 also. There will be good stuff to buy eventually. There will be. But I still don't think we are at the bottom right now. That's my personal view. I'm a day trader. Listen, I'm no like mutual fund manager or something that I really know when the bottom is. But just personally, I feel like there's one big move left. Maybe I think once we finish all this, I think the bottom will be about 50% down from the top.
For you, what signaled a clear regime shift? Because as we've seen over the past couple of years, there's been a few kind of nasty sell-offs, but they've been reasonably short-lived. This has obviously gone much further and much faster. Was there a point in the past, let's say 20 days, which signaled a clear regime shift to you?
I think for me, the first halt in the market, I've traded 16 years in this market. I've traded to 2008. I've traded through flash crashes. I've traded through a lot of stuff, but I've seen futures, limit down. That's not a big deal, but I've never seen the market halt, right? And I couldn't believe it when the market halted for the first time. And I was like, you know what? This is different. I mean, this is a lot of people have to, unwind their positions out here because, if the worst case scenario happens, right, people are going to be stuck big time in this. There's millions of billions and trillions of passive money that is stuck, so everyone's going to just unload. And I was like, you know what? I think my biggest mistake, which I did, was to buy Boeing. I think I thought Boeing is untouchable. That's what I thought. And I kept buying Boeing. And I'm like, maybe I should not have bought it. I mean, forget not about it. I'm already getting out of my Boeing position because I'm like, you know what? I mean, if you think about Boeing, right, this is the way I thought about it. I'm like, Boeing is pretty much Airbus and Boeing are the only people in this world that make planes, right? End of the day, the world is going to become a bigger place. There's going to be more people in this world. There's going to be more travel. End of the day, people have to buy more planes. It's just normal, that's what's going to happen eventually. But that's not how the stock is being treated right now, And I still have that view, but at the same time, I'm just like, you know what? This is not the time. Maybe there'll be a better price, a better time, and I don't want to be early in this market, because I mean, I think in this market now, cash is king, right? I mean, people like Microsoft, people like Apple, who have like 150, 200 billion dollars sitting with them, they become like the gods of the market right now. Like, listen, because worst case we can get through this. The people who have over leveraged, like and everyone over leveraged in this market, right? I mean, because you're in a bull market, everything is great, buybacks, dividend increase, let's borrow money for cheap, and build another hotel like Marriott, and all those guys, they just over leverage themselves, and that's the problem with with America as a whole, is that we over leverage all our our credit cards and this and that. So when shit hits the fan, we always go to an extreme downturn, and this is what happened, really quick. But again, we're still in a state of fear right now. So it's still early. I don't know when this is all going to unwind.
A big part of performing well in these conditions, I'm sure, comes down to preparedness. What are you doing to prepare prior to the open each day?
One thing to do very in this environment is to be flexible. I think that's very important. Is like, don't come with pre-notions, pre-notions that you're going to buy the market because you're down 2,500 points. It doesn't mean anything now. You just have to be flexible. See, once you see what you see, and if you like it, then go for it. Do not have these preconceived notions that, damn, dude, Apple's at 240, 230, let's go buy it. You never know what's going to happen, you just have to be flexible. And I think, experience in this market is everything. I feel like, I mean, in this year, I mean, I'm doing well because I've seen a part of 2008. I've seen a big part of 2008. I've seen flash crashes. I've seen everything. There's easy money and there's tough money, right? The easy money is arbitrage stuff. When things halted, for example, there's algorithms that trade the open, right? Obviously, but when things halted, those algorithms were not working, right? So when something halts and the whole market is halted, all the algorithms are shut off. So what a stock is going to open at versus what it closed at is a big difference. And so I started looking at those things, and I'm like, you know what? Just before the halt happened, UNH, for example, closed at 170. After the halt, it's opening at 155. I'm like, you know what? SPY is not opening down that much as the way UNH is doing it. That's because there was no liquidity in the market at those halts because of algorithms being shut off, because the algorithms were not programmed for halts. they were programmed for on open, on close, programmed for throughout the day. But when a stock opens after whatever half an hour or of the open, they don't know what to do. So there's a lot of things like this which come with experience that you start watching. You're like, what? This is what I saw. This is what I like, and there's so much craziness in the market by this because of that. There's people selling things really quickly, really fast, just panic selling. You can buy reversals. You can go momentum. A lot of these stocks have become short sell restricted. If someone doesn't understand that, basically, if a stock goes down more than 10%, and for 2 days, it becomes short sell restricted, which means that you can only buy if there's an uptick. Sorry, you can only short if there's an uptick, right? So all these scenarios are coming in, and SPY itself has become short sell restricted. That creates a lot of problem because if you want to short SPY, it has to have an uptick before you can short it. So there's a lot of stuff that's happening in the market. It's just I think this is where experience comes in hand. It's because this is once in a lifetime. No, I said that in 2008, it's a once in a lifetime opportunity, but it's come back again. So I don't want to say that. It's still unfortunate in our lives also that we always make money when things go bad, when the whole world is like crying about stuff, and we like just that's why I never tell my P&L to anyone, because I'm like it's just feels a little unethical sometimes to do it. But yeah, this is extraordinary times, and you just have to stand up and trade and put risk on, because there's some trades where you just have to put the risk on. You say, listen, what if you're right, you're going to make 3, 4, 5 points. If you're wrong, you just have to learn to manage your risk. I think risk management in this market is probably the biggest thing. You can't be stubborn. You can't say like this is not possible. Boeing cannot be going to $90. Boeing cannot fall 150 points in a week. It just did. And you just have to agree to it and say, listen, what, get out, use a risk, get in again when you think it's the right time, but get out right now.
On that subject, there seems to be almost like two mindsets around trading during these conditions. There's one where it's, these conditions are too abnormal. It's time to dial back the risk. And then there's the other mindset, which is, this is a very rare opportunity right now. It doesn't come around very often. Increasing risk is actually justified during periods like this. How would you encourage a junior trader to think about, which side they might be leaning towards?
I mean, I do have a student. He is a junior trader. He's only been in for 6 months. And I'm like, listen, this is the market where you stand up and, you show me how, you have the balls. It doesn't mean you go and be stupid. It means you do a calculated risk, right? If you see something that you like and you think, you can surely there's a good chance you can make money, you go step on it. Don't worry, because in this market, right, there's going to be so much opportunities that if you're wrong, you can always come back from it, right? In a dead market, like, 2 months ago, if I was down 30, 40,000, I'm like, yeah, my day is done. Today, I'm like, listen, if I'm down 20, also down, I was down 60 yesterday, and I finished the day up 20, so, it's just like in days like this, I'm not worried about being down because I know there's enough opportunities to come back. When there's not opportunities, that's the day when I'm like, listen, you're going to manage risk even harder. Right now, I'm like, you know what? If the opportunity is there, you got to take the risk. You might be wrong, but there's other places where you can be right and come back from it. So one of my students is doing is like he's looking at my trades and trying to like emulate the same thing, and that's the way to do it. It's tough because he's seeing the craziness of this market very early in his career. The next time he sees it, he's going to be even more aggressive and he'll stand up even more. But right now he's like, oh, this guy is doing it, so I'm just going to stand up because he's doing it. He probably knows it's right. But eventually, that's how you learn. You just have to hold someone's hand and walk, and soon they'll start running themselves. End of the day. To answer your question, I would say, you got to take on risk. It just depends what kind of trader you are, right? I'm a day trader. I'm in and out of positions quickly. If you're going to sit on positions overnight and things like that, nah. You got to be more sensible. You got to be more, maybe take a hedge or things like that. Right now, I got to clean my slate every day because, either we are up 1,000 points or we're down 1,000 points. Forget up or down. Maybe 2,000 points on the Dow these days.
Yeah, I think that's really wise, Nish. How are you more specifically actually managing risk through this? Like, are there any rules that you are enforcing upon yourself?
As I said, not to be stubborn about things. Unbelievable situations are happening around you. At the same time, you just have to say, listen, you know what? You have to cut your losses. That's something which is ingrained in me. I just see red and I start selling, and just like I start covering my position or whatever I have to do. I get out, but I might get in again, maybe like 15 minutes later again, and trade the same stock again. But I don't know. My mind is conditioned. It's just repetitive. 16 years of trading and continuously doing it. It just comes automatically to you now. I just don't have to think about it as much. But at the same time, if you make one wrong move in this market, you can get hit pretty badly. So I'm just trying to I double take on everything. I'm like, you know what? Should I take this amount of size? Yeah, okay, fine. Let's go do it. Just have a second thought before I do sometimes, in this market because it's so crazy. Let me tell you one thing also, right? In this market, I haven't seen crazy panic yet. Yes, we've been gapped down. We have sold off all that. But the panic of a flash crash, is not been seen out here. The panic of 2008 that I saw hasn't been seen here. And I feel like when that happens, that's going to be the bottom of the market or very close to the bottom of the market. And that's my personal view because it's still been orderly selling, It hasn't been, it's just been a lot of selling, but still been very orderly selling. Like, I remember in the flash crash, I'd bought Home Depot about 17, 18 points. It fell in about a minute. Today, Home Depot is down 18, 20 points, but it's down over the whole day. So you see the difference. The quickness and like the lack of liquidity that was there in flash crashes is not seen here, right? As of right now, it's still there's a lot of liquidity to get in, get out of positions, but yeah, there's a lot of. I think overnight, there's a lot more happening than it happened back then.
So you feel like we haven't seen that real big volume capitulation, which often signals a bottom coming yet?
Exactly. We need to, this is what I think, this is just me, is that we need to open down, swoosh down, and then finish higher for the day, and then come back and finish higher for the day. Get all the shorts out, and when the day that happens, I think there's a pretty good chance that we're down to the close, the bottom of the market, I feel. But it has to happen at the open, when you fall down and you retrace back all those losses and, finish up high. The day that happens, I think we might be at the bottom.
When the trading day is underway with so much moving right now, how do you determine where to focus your attention?
That's where colleagues come in handy, and you have your own tickers that you've programmed over a long period of time. Obviously, my company has great tools to go and figure and find situations that are unique. And my friends, people who sit left and right of me, we keep talking, we keep saying like, hey, listen, I'm checking out this wood, and they're saying, we're checking out this symbol. So it's great because this way, we have 3 pairs of eyes, watching 3 different things. And I'm like, listen, call it when you think it's going to turn. And, they'll call it when it's going to turn. I'm going to call it when I see something turn. And we just keep saying symbols and, keep talking throughout the day. This is the hardest I've ever worked in 16 years. Hardest. I have sat on my desk for 8 hours for the last, 15, 16 days. Lunch has been ordered inside. I drink water so that I could go and pee. It's just been crazy. We're all working so hard. I've never waited for the weekend as much as I waited right now and my wife was telling me the same thing. She's like, I've never heard you say that. Thank God the weekend's here. You always said that, oh man, I can't trade on a weekend, So she's also like, she's like, wait, man, you must be really tired because you're actually wanting a weekend coming, And we're all passionate traders out here, So it's like, you just want to trade. And it's hard to get some sleep in the night, at night because you're always thinking. Like I remember when oil fell like 20% when Saudi did the that thing, and I saw the futures down about 1,300, and I'm like, oh my God, like what's going to happen in the night? It's going to be limit down. I'm going to halt. The next day, and you start thinking, and you start to try to fall asleep, and then suddenly at 1:30 in the morning you wake up and you're like, what? Let me just check the futures. I check the futures, like, down 1,400. I'm like, okay, fine, go back to sleep, start, you're still thinking about trading and how you're going to manage the day and things like that. Again, you wake up at 4:30, you like, let me see the futures. And, you again try to go to sleep. And then by 5:30, you again up. And I'm like, what? Makes no sense, man. I just need to go to work and finish this day. And then, you crash after the day.
Just mentally drained.
Yeah, mentally drained, physically drained, backs are hurting, I'm wearing a wrist guard right now because I've typed. I think in this month I must have traded at least 15, 20 million shares. At least. I haven't paid attention, but I'm averaging about 2 or 3 million a day. At least.
Are you ready to get serious about options trading? Then join Tasty Trade. Investopedia's trade is packed with advanced support during trading at Options involves risks and are not suitable for all capital, or sat on the sidelines because your account balance felt too small to matter. Good news, IPOs, and short anything you like within minutes. No subscriptions, no minimum assent. Every decade, the market reinvents itself.
How has your approach altered from how you were trading earlier in the year? Like, what have you done to adapt to this environment? Like, the same way you were trading in January, I presume, is not the same way you're trading right now. I mean, I'm sure it's probably similar in many ways, but there are probably some adjustments as well.
Yeah, for sure. I was talking to a friend of mine yesterday, and I'm like, the way the stocks are falling. See, I was a reversal trader, right? So I'm looking for things going down, and then I'm buying them, and they're turning around. In this market, it doesn't happen that often now anymore. So we're like, wait, when do we buy things that are going down? Because it's very different when a stock is short sell restricted, because it's just like sell orders come in, and they have to get done. And how do you figure out when they're done? Because it's like, I don't know who's selling on the other end, but like, they just come with a big size and they keep coming down, 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 down. And you try to figure out how much is left in them. And, so I'm just trying to figure that out more right now. That's where, it's a challenge. And that's how I was down 60,000 the other day, because I was trying to buy it like the way I normally buy in January. And I'm like, you know what? Things have changed. The way to buy it now is much later. Wait for the ultimate panic. We used to have panic that time in January, and we would buy it and it would turn around usually. But now it's like a different level of panic I need to see. The level of panic that was there in January comes much earlier in the day out here. So it's a little different. So trying to adapt to that. And I think today was the first day I kind of adapted to that. And I felt like, okay, you know what? I'm seeing things differently. When things are down, 40, 50%, even a 10% move after that can ruin your day, So you just have to be super precise. So, I'm in, I'm out, I'm controlling my risk, because I know when I'm right, it's going to be a 3 or 4 point move up. So I can't give, more than 40, 50 cents if I'm wrong anytime. So trying to be wrong less obviously helps, but I'm just trying to manage my risk on those, because I know the time I'm going to be right, I need to be in the right size. And I need to be, I need to take profits also, because these things move 3, 4 points so quickly. And you're like, oh my God, this looks amazing. This can retrace back all 50% and that's down today. Nah, it's not going to happen the way that used to happen in January, where, you would get a good retracement, but slow and steady retracement. Now the retracement is much faster and much short-lived, So those things have changed. Adding more size to things that one thing that it's important and you learn is that once you have a bankroll, like we get paid every month. So let's say if I'm up pretty good in the month, right, I don't mind risking more on good situations. I'm like, normally what I would take 20,000 shares, I might take 70,000 shares, 80,000 shares. I'm like, I'm not scared to lose money. And that only happens when you have a bankroll, whatever you say. Very few traders have that kind of guts and that kind of, there are few traders that do it. Like, it doesn't matter to them how much they're up or down in the month, and they trade the same way. For me, I mentally, I know that's what I am. When I have enough money lying, in that month where, I'm like, I don't mind if I'm wrong and if I lose 15, 20,000, when I'm up a decent amount, I try and, be more risky. I'll try and push the envelope more. I'll press my bets a little bit more. I'll believe in myself a little bit more. Confidence automatically only comes when you start being right multiple times, and then you start, adding to your positions more and more, and you believe in yourself. And obviously, the money comes along with it, so you just start. It's like a clockwork, and it just works well when you do things right. Somehow for me, it's like if I'm positive, it's because I'm doing things right. I try not to have a negative day, because my mind changes. So it's just good to know yourself, and I think 16 years of trading, you start to get to know yourself really well.
Yeah, it's a long time, man. More specifically on this point here, how are you deciding on key points or maybe optimal points on where to enter and exit your trades?
It's a tough question to answer without someone sitting right next to me and me explaining what the thought process was when I went in this trade. Because there's so many other factors in this market that determine it's Trump tweeting, it's press conferences, it's the number of viruses that are hitting New York City, or is New York City on a lockdown? Now San Francisco is on a lockdown. It's just so much happening that even if a good setup is there, it becomes into a bad setup because of what happens on the news at times. So I mean, you just have to say this is where I want to be in. If doesn't work out the way it is, you cut your losses and move on. It's just risk management right now. It's just you will be right because you know the situation that you want to see. It's about other factors, and you just have to be just be quick. I mean, that's something which we are. I think we're very quick with our fingers. Like we kind of sell super quick, and we get in positions, get out positions. It's just we're pretty nimble. It's not like like, oh, let's buy this, hold it for like 10-15 minutes and then see what happens. Let's put a stop. I'm not doing all that. I'm just like I'm like, do I like it? Okay, fine, it's working in my direction. Move on to the next setup. And the way I do is I just arrange my P&L from winners to losers. So I'm just managing my losers most of the time. And then I'll keep looking at the top winner, and I'll start putting out orders to get out on those winners, So if they hit my orders, great. If it doesn't, I'm still watching everything as much as possible. You're multitasking, man.
Yeah, I know that was a bit of a tricky question, but I just wanted to ask it. I was interested to hear how you would answer. So very good, man. Last question. I know you've done very well during this downturn. Ultimately, what do you put it down to? What skills and abilities have enabled you to make large gains?
One is obviously risk reward. I've always said that. Second is experience. Honestly, experience is a big factor in this. It's about, you've seen situations, what to see in those situations, how the close is going to behave. It's just, just also knowledge of just everything now. After 16 years, you just gather knowledge of so many different parts of the market. So I feel like, risk reward, experience, I think talking to other traders around me, seeing what they are seeing, what they don't like. Sometimes, you're in it. So just talk to traders, manage your risk. There's lots of, just don't think about one side of the market. Always think that when someone is buying, someone is selling, someone thinks they are right and someone thinks they're wrong. So, just have that basic mentality in mind. Come in, wake up early, have a clear mind, try to sleep well. That one night I didn't sleep that great and then I drank like 5 cups of tea after that, and then throughout the whole day, and I was like, a jittery mess. Not great. I did good that day, but I just didn't like the way I was, feeling at all. I don't know, enjoy. For me, I enjoy these moments also. Like it's like, once in a lifetime kind of situation. I'm like sitting throughout the day. This is what I love doing. And that's the most important thing, I think, is that if you love trading and you love being in front of the market, somehow you'll do it. Like my student, he used to work for Microsoft. He quit Microsoft to be a trader because he just loves and he was telling me that this is the first time in his life that he's actually enjoyed something that he's doing. So it's very important to enjoy, because you will do well if you enjoy something, I feel.
Yeah. All right, Nish. Well, I know you've got to run very shortly, so I'll let you go. I just want to take this opportunity to have a quick catch up with you and sort of discuss what's been going on as of late. So I really appreciate you taking the time. I know you have a lot going on right now. It's a busy period for you. So yeah, thanks once again.
Yeah, other than the market being busy, there's even kids at home, and the wife has to take care of both the kids. So it takes a family to really run a trader. It's not a one-man job. It takes everyone.
You have a good team around you.
Thanks, man.
Yeah. All right, Nish, enjoy your evening.
Thanks for the call, Aaron.
Yeah, we'll chat soon. Thank you.
Thanks, buddy.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Traders, welcome to the show. This is episode 192. Similar to the last episode with Nishant Porbandawala, this episode also has a relevant focus on current events. As we've seen making headlines recently, reserve banks of numerous countries have been adding liquidity to the market in an effort to stabilize economies. While some listeners will already understand exactly how reserve banks conduct these operations, I figure there will be many others, myself included, who don't completely grasp what takes place below the surface. To get clarity on the subject, I kindly asked Kevin Muir to appear on Chat with Traders for a second time and to explain the actions of reserve banks during this market downturn. Because, in my opinion, Kevin has a gift for analysing and explaining complex subjects in a way which is easy to follow. Kevin was a derivatives trader for a Canadian bank during the 90s and has been an independent trader from 2000 onward. He also writes a brilliant financial newsletter, The Macro Tourist, and co-hosts the Market Huddle podcast. For links to his newsletter, podcast, as well as our first interview, check the show notes at chatwithtraders.com/192. Kevin, before we get into your thoughts and your perspectives too much on what's happening, let's just get some clarity about what's actually taking place. Now, one of the things which has been making headlines, not only in the US, but Australia, Europe, etc., is central banks injecting liquidity into the market. So one of the questions I'd like to start things with is what exactly happens when a reserve bank adds liquidity into the market?
Well, Aaron, they can do it through a variety of different methods. The most common one is they actually go out and buy securities. And if you go look at the Federal Reserve, they actually announced on Friday the schedule for the rest of the week of what they were going to buy. And you'll see that today for Monday, March 30th, at 9:30 to 9:50, they were going to buy coupons, treasury coupons from the 7 to 20-year sector for $6 billion. Then at 10:20 to 10:40, they were going to buy the 4.5 to 7-year sector for $11 billion, and so on and so on. So the way they actually do this operation is that they go out, they announce to the marketplace that they're looking for $6 billion of these securities. Then they go talk to the primary dealers and they tell them to submit their offers. And the primary dealers send in a list at that scheduled time. And then the Fed actually just lifts their offers. They actually buy it. So the primary dealer was holding this in inventory, and they're no longer holding it in inventory. And in a lot of ways, it's that simple. They're buying the assets from the marketplace that the marketplace is having trouble financing and warehousing.
So what's an example of a primary dealer? Like, who would that be?
It would be a JP Morgan or like Royal Bank, I believe, is a primary dealer. Even though we're Canadian, we're a primary dealer. They're basically just very kind of senior banks that deal directly with the Fed.
And why would someone like JP Morgan or whoever the other primary dealers might be, why would they actually want to sell to the Fed?
Well, they're selling to the Fed because they're making markets in these securities all the time. And not only that, it is their job to go and to facilitate the trades of the Fed. Just like it's their job to bid on the securities when the Treasury is auctioning securities, they're actually obligated to bid for a certain amount. It is their duty to actually help the Fed conduct these operations. Someone has to trade with the Fed. They can't just go out and buy directly from the clients. They're basically a middleman between the clients and the Federal Reserve. Interestingly enough, Aaron, that the Fed is buying so much right now that for the first time ever, I was talking to a tips trader that was telling me that the Fed was trying to buy $6 or $7 billion of tips, and the primary dealers only offered them 4.7. They literally ran out of inventory to offer to the Federal Reserve. And that's the one thing I just would like people to kind of understand is the level and the speed upon which they're doing these purchases is completely unprecedented. They announced 2 weeks ago that they were going to do $700 billion of quantitative easing, and they left it open. They said it was going to be over a period of a couple of months, but they didn't say that they couldn't stagger some more at the beginning. And so what they did was they went and looked at the state of the market, and they got a feel for how much they needed to do. Well, they literally went through that $700 billion in the first week. They are buying the equivalent of a 2008 quantitative easing. It used to be basically 60 to 80 billion. I can't remember the exact number. They were doing that every day for the past 2 weeks. The stack of blue tickets on the Federal Reserve's desk is monstrous. And then there's other ways as well that they can provide liquidity to the market. One of the most interesting things that they've done is that they've done these swap lines where they actually go and provide US dollars to other central banks. They did this in 2008. They did it to I can't remember, I think there's 4 standard banks that they do it with. It's Bank of Canada, ECB, Bank of England, and I don't know, I'm not sure who else it is, but they go and they provide these kind of liquidity, these US dollar liquidity to just free up the system. Well, there was such a demand for US dollars at this time that they expanded their counterparties to 10 different banks, central banks. And this was all in an attempt to try to help the world economy that was in desperate need of US dollars to provide the liquidity that no one else could provide.
You did say something in your answer there. You spoke about TIPS. What are TIPS?
TIPS are Treasury inflation protected securities. They're just another form of government security. So the Fed, not only do they buy regular government bonds, but they also buy Treasury inflation protected securities.
Okay. And what is the goal that the Fed is trying to accomplish by doing this?
Their goal is to try to make the system have enough kind of liquidity so that it begins to operate correctly again. See, what happens is that there's basically not enough money in the system because credit is being contracted, and basically there's not enough chips to go around. So therefore, it ends up being this kind of game of whack-a-mole that, one person whacks it and then it comes up again and they try to whack it again. And it just becomes a self-fulfilling prophecy where the credit contraction of selling causes the value to go down, which then means that more people have to sell. And so what they're trying to do is provide enough liquidity to stop that kind of that kind of reinforcing kind of spiral. And what they do is they take all the securities that they can that from the dealers' balance sheets that they're having trouble financing and having trouble owning, so that the dealers can buy other things that are more risky. So the goal is to try to make it so that these banks, the JP Morgans of the world, don't need to worry about financing treasuries and don't need to worry about that. And they can go out and they can buy the more risky securities that basically the Fed should not be buying. Because at the end of the day, the Fed is supposed to buy only government securities. Now, it is being kind of, let us just say, it's changing this time. In 2008, there was the TARP program, and there was some different things, and the Fed got in trouble because they blurred the lines of what they were allowed to buy. And then Congress went and they actually tied their hands again. But in this case, what's happened is the Treasury's gone and actually taken a role where they've worked hand in hand with the Fed so that the Fed can buy corporate bonds, but the Treasury takes the first loss so that the Fed is in essence still taking the government risk, and it's a riskless security for the Federal Reserve. Because the Federal Reserve is not supposed to be trying to pick which companies should survive and which shouldn't. They shouldn't be sitting there going, I'm going to buy GE paper, but I'm not going to buy Boeing paper. That's not their goal. Their goal is to provide liquidity for the system. Now, unfortunately, what happened was because there was this, terrible virus, and because nobody wanted to own any securities, the government was forced to go and say, no, we're going to backstop investment grade paper as well. Meaning investment grade is the kind of higher grade corporate paper, bonds. And so what they did was the Fed found a way, working hand in hand with the Treasury, to actually buy corporate paper.
Can you just explain what corporate paper is?
Okay, so that's like GE or Boeing or Microsoft or Apple issues bonds, and those bonds trade in the open market, and that would be an example of corporate paper. Investment grade has to do with the ratings attached to that bond, and generally that's considered the higher quality companies. And then it goes from there, it goes into high yield or junk, which is anything below triple B. And that is kind of what the Fed said. We're not going to buy any of that, but we're going to buy investment grade paper.
Okay, so how come they were doing that this time? Like, why this time?
Because the market became so dysfunctional and that there was nobody willing to buy it, that the Fed needed to backstop it.
Now, is this, correct me if I misunderstood you here, but when you were talking earlier, it sounds as though the Fed comes in with all these billions to buy back government bonds, and they might do so from a primary dealer such as JP Morgan, which frees up some capital with JP Morgan, which then allows them to go and purchase more risky assets if necessary.
Right, or to make room for their balance sheet for the assets that they need to hold. Either way, it's just helping the system in terms of providing liquidity to the system.
Okay, so in this case, what happens if the Fed announces that they're injecting $700 billion worth of liquidity into the market? What do they do when they don't get the reaction that was intended? I don't remember exactly which date it was, but I think it was a Sunday evening when the e-money came back online, and they must have announced it shortly after or just after the open, and it instantly went limit down.
Right. Well, first of all, I would argue that the Fed does not care about the stock market. Well, they care, but that's not their primary goal. They are more interested in the functioning of the credit markets. The stock market is something that they watch out of the corner of their eye, and it's obviously important as a signal. But really, what kind of lit the fire under their ass in terms of actually doing stuff was when the credit markets started breaking. And that's when they decided that, nope, we got to get in there and we have to do it. Because if the credit markets start breaking, then everything else just falls to the wayside really quickly. And this is one of the things that I would like to stress for, when investors are thinking about this environment and they're thinking about the different opportunities there are after this huge sell-off in, from the virus. And they see guys like Mark Lazary from Avenue Capital or Seth Klarman going out and actually raising money to go out and buy assets. One of the things that I want them to probably understand is that these guys are probably not buying the equity. What they are buying, more often than not, are these distressed bonds that are high quality bonds that are trading at levels that are just wrong. And so one of the things that you have to just keep in the back of your mind is that some of the smartest guys out there are actually seeing the opportunities today and actually committing capital, but the opportunities are not in the equity market. They're actually in the corporate market.
Let's just take a step back there. You said that the Fed is not so concerned about the actual stock market, more so about the credit market. So when you talk about the credit market, are you referring to the government bonds?
The credit market is both government bonds and also corporate bonds.
Okay.
It's bonds of all sort. It's also money market. It's just all the functioning, the day-to-day functioning of the kind of the credit that goes back and forth between companies and the cash flows and the financing of commercial paper and the financing of the government's balance sheet. It's all that is infinitely more important than the equity market.
Right. So you said that the Fed wasn't so concerned about the stock market breaking down. It was more about the credit market breaking down. So most of us listening to this know what it looks like when the stock market breaks down. What does it look like when the credit market begins to break down?
Well, the first thing you'll notice is that securities that are not on, like what are called off the run, meaning that there's a standard bond that everybody trades that's the most recent bond. But then there's the other ones, the ones that were previously auctioned. And those usually trade at a slight discount to the on the run because there's less liquidity. Well, all of a sudden, investors couldn't sell those at all. So that's called the spread between the on the run and off the run bonds. And that was a trade that, for example, in 1998, that long-term capital had on. They would go buy the 29.5-year bond and sell the 30-year bond. And eventually that spread would go, back into line, but they would have to hold it for a little while. Well, those spreads, those kind of trades started blowing out, meaning that they, whereas they usually would trade at a 20, basis point difference, they started trading at a 100 basis point difference. And then you would see things like high yield and corporate spreads, meaning the price that a corporation has to pay versus the government bond. So if the government borrows money at 1 and an investment grade borrows money at 3, that would be called a 200-point credit spread, meaning that you have to pay 200 extra over the government. Well, those spreads went from, I think that, let's just have a look here. I have this written down. Let me grab it. The aggregate corporate spread went from 100 basis points, and then it went to 365 in the space of 2 weeks. That's just that's unheard of. The high yield went from 350 basis points to 1,100 basis points. So whereas you had, companies that used to be able to borrow money at 5%, they now all of a sudden had to pay 13%. Is that sort of moves that you imagine if you're all of a sudden you're going and your mortgage is floating and they tell you it's gone up by 800 basis points in the space of 2 weeks. That's the sort of stress and that causes the system to really get into trouble because it ends up being that without that kind of those spreads blowing out like that, the whole thing starts kind of unraveling.
Just going back to the question I asked you a little earlier, what does the Fed or any reserve bank for that matter, what do they do if their injection of liquidity doesn't have the intended reaction? And has it had the intended reaction this far?
Well, I would say that when they announced the first one, because don't forget they've done 2 QEs so far. They did the first one, which was $700 billion, And now they came back with the QE unlimited, which is basically no amount and we will do whatever it takes. The first one, the 700 billion, they didn't tie their hands about how much they would buy every day. They left it open-ended. And I think that they went into the market, they bought it, and they realized how much was for sale, and they upped the amount that they were going to buy. So when you ask, what does the Fed do when it doesn't have the reaction that it's intended, they do more. So they realize that the system, they don't know the right number because they don't understand the stresses like that well in terms of like the specific how much it's going to take to fix it. So they're always kind of feeling their way along, buying some, seeing what's happening to spreads, see what happens, buying some more tomorrow. And they do that. So in fact, I would say that the first one didn't have the effect that they wanted it to have because they were forced to come back with the second one, which was QE Unlimited with the extra swap lines and the corporate paper. So that's the long and short of it, is that when it doesn't have the result that they're intended, they do more. And this is an important part, Aaron, to think about, is that a lot of people will think to themselves, oh, the Fed's going to run out of money. The Fed can never run out of money. They are the issuer of the government is the issuer of the currency. Theoretically, they could buy every bond on offer if they wanted to. And so when you're thinking about shorting against this and thinking to yourself, oh, you know what, the Fed's going to stop and the Fed's going to run out of money, or this isn't going to work. I always say be very careful about that idea, because the Fed could literally just keep buying and buying and buying and buying. There's nothing even stopping them from buying stocks if we change the rules that we operate under. That is a self-imposed rule, meaning that the Congress has told the Fed that they can't buy stocks. But in other countries, the central banks are allowed to buy stocks. Japan, they're buying stocks. And in fact, in Switzerland, they're buying U.S. stocks. So imagine a situation where it gets really bad and the virus continues to kind of, make society unstable. And one of the worries is that we're having a financial crisis. I could envision a world where the Fed starts buying S&P 500s. It's not, out of the realm of possibility. And there's nothing fundamentally stopping them because they are the issuer of the credit. They could just, debit one side and credit the other. And it's as simple as that. They're just entries in a computer.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform, where live clearing fees still apply. Explode and tap into over $12,000 in buying power. Need to trade yet? Trade the new era of
actually intervening in capital markets.
Well, Aaron, some people will say that, the hard money guys that think that we should be on a gold standard would argue that there's tons of negative effects, and that this is the reason that we're in this predicament is because the Fed keeps intervening and doing this. I don't know if I buy that argument, but I will say that without the Fed, we would have a situation where we would have had more deflationary busts. Now, you might argue that that's what the system needs. The system needs kind of a cleansing deflationary bust. I would argue that it would actually have caused massive kind of unemployment, and it might have cleansed the system, but it would have been very painful. So it's a tough philosophical thing that comes down to what you believe money is and how it should operate, and who's the benefit for. And what is the goal of the Federal Reserve? Is the Federal Reserve there to try to maximize employment, or is the Federal Reserve there trying to maximize or maintain the value of the dollar?
So as we've been talking about here, central banks adding liquidity into the marketplace, is this something which just takes place on an ongoing basis, week after week, and it normally doesn't make the headlines? Is this something which happens regularly anyway? It's normally just on a smaller scale.
So there was a time when the Federal Reserve basically didn't announce any of their changes, and would execute a monetary policy by intervening in the market and buying or selling T-bills. And I remember a time, I'm showing my age, but that you would have to wait till 11:45, and you would go watch for them, and you would see what they did. And if they conducted operations, you could see that they had changed the rate of the interest rates through their open market operations. So to answer your question is that it used to be that the Fed was constantly buying and selling T-bills to maintain the rate that they were trying to kind of target. Then what happened is in 2008, when we had the great financial crisis, we basically hit the zero bound, and then that changed the way that the whole system operates, and we went to a system with interest on excess reserves. And during that period, when the Fed can actually just set the rate and basically have a savings account that the primary dealers use, then there's no need for them to buy and sell kind of securities on a regular basis. Now, having said that, don't forget that they had run up their balance sheet in the QE 1, 2, and 3 under Bernanke, and then they were trying to wind that down under Powell when he first came in. That was what the taper and eventually the quantitative tightening. Quantitative tightening is the exact opposite of quantitative easing, that instead of the Federal Reserve kind of buying securities, they sell securities. And so they ask dealers for bids instead of asking dealers for offers. And so during those periods, they actually were in the markets on a regular basis, but it wasn't to the extent that they're in there today. When the quantitative tightening, I think they might have sold once or twice a week. And so there would be 2 operations a week at most. Even during the quantitative easing, I think it was 2 operations a week. This one is just, this quantitative unlimited is completely and utterly unprecedented. Like I'm counting it here, 1, 2, 3, 4, 5, 6, 7. They have 7 purchases per day of different securities. So this is much, much different. The virus was something that we've never seen before, and the Fed's reaction to the virus is something we've never seen before.
What do you make of all this? Let's flip this to get a bit more of your actual perspective and your thoughts on what's taking place at the moment, and I guess how this might play out a little bit. As you've said a couple times, it's uncharted territory. We've not seen something like this before. Yeah, what are you seeing?
Well, I understand why the Fed's doing it. I'm sympathetic to it. And I think that they're doing the right thing. And even if I didn't think they were doing the right thing, it doesn't matter what I think. Well, all that matters is what they're actually doing. I saw that the Bank of Canada the other day, the governor of the Bank of Canada said something to the effect that some have suggested that he is using a lot of firepower. And then he says, a firefighter has never been criticized for using too much water. The central bankers of the world are rightfully scared about a shock to the system because this is something that's, we basically shut off our economy for a month, or it could be 2 months or 3 months, who knows? So they are throwing everything they have at it. And whereas a lot of kind of market pundits will look at it and say that's going to end badly, I think I'm going to short like S&Ps because it's going to cause, this thing's going to collapse in on itself. I'm more worried about the opposite. I'm more worried they're going to throw so much at this thing that it's going to ignite like a fireball. And I look at when we come on the other side of this, how they're going to unwind this is going to be very, very difficult. But I don't think they're worrying about that right now because there's just, this is a lot different than the 2008 crisis. In the 2008 crisis, it was a bunch of greedy banksters that had kind of gotten over their skis and gotten into trouble. Now, eventually, it threatened to take down the whole system, and the central banks had to come to the rescue. But on the whole, they didn't really want to save the system. They wanted it to cleanse out. They wanted to get Lehman to be taught a lesson. They wanted to have these things change. They wanted the system to kind of de-lever because it was too levered up. In this case, This was an exogenous event that was really nobody's fault. And not only that, it's not some greedy banksters this time. It's, everybody, including the mom and pops that, did nothing wrong. So when I look at the kind of central banks, they have the moral authority to do whatever it takes. And you'll see them saying that time and time again. We will do whatever it takes. And if there's one thing I would just kind of like to leave, your listeners with, it's that don't forget that. They will continue to buy and support markets in whatever size is needed. And they are not going to get scared off because it's a certain size. They are just going to keep standing in there and they're going to keep buying it. And if it ends up being that they own every treasury on the market, so be it.
One of the things you said to me prior to our call is that you'd like to speak about how we've never seen the government, I think it was the government and the Treasury, correct me if I'm wrong there, working so closely together as they are at the moment. Is that something you'd like to speak to?
Sure. Yeah. No, I'd love to talk about that. I've contended that Donald Trump was the most MMT president that we've ever had, modern monetary theory. And what a modern monetary theory kind of theorist believes is that the government is never constrained by financial constraints, meaning that the people that tell you, the government has 100% of debt to GDP, they don't worry about that. They say that the government is only constrained by real resources. And what does that mean? It means that the government can keep spending until they reach a point where they use so much real resources, that they cause inflation. And I've argued that Donald Trump is the most MMT president that we've ever had, even to the fact that you take like his stimulus plan. He did a stimulus plan 8 years into economic expansion. Most Keynesians would tell you at that point that you should be trying to balance budgets, not Donald Trump. And when they asked him why, he wanted the interest rates lower, and when they asked him why, if the economy is so good, why he wants interest rates lower, he says because there's no inflation, which is exactly what an MMTer would say. So when we come to this point, we get to this kind of crisis that we're having from the virus, and a lot of kind of Austrians and hard money guys would say, well, the government can't be spending at this point because we don't have the balance sheet to do it. We're already indebted by whatever it is, and we don't want to be saddling our grandchildren with this debt. Well, that isn't happening here. The government is going and doing a kind of a fiscal stimulus or saving a fiscal kind of rescue package to the tune of 10% of GDP. Japan is talking about doing 16% of GDP. So governments are spending like nobody's business, and rightfully so, because there's been a huge demand shock. And if you think about it, the Federal Reserve and other central banks are there to finance it. And if it comes down to the market ends up being worried about how much the government is spending, we could eventually hit a point where instead of the government issuing bonds and then the Fed buying them back through quantitative easing, we just get a situation where the Federal Reserve says we're going to, do $2 trillion of spending, and the Fed's going to buy it all. Because if you think about the process that we're going about doing it, the Treasury spends, they issue bonds, the primary dealers buy them, the public, trades them, and then the Treasury or the Federal Reserve buys them back. So we could just eliminate the middleman, and that is one of the things that should give kind of the hard money guys shivers, and because eventually we're going to see a situation where that's occurring. And we've kind of gone through 3 decades or 4 decades of lower and lower inflation rates. And everybody thinks that we can't create inflation. And I argue that we can't create inflation because we keep relying on the private sector to try to create inflation, through the banking system and through people taking out loans. Well, as we saddle people with more and more debt, it becomes more and more difficult for them to to take out even, the incremental amount of debt ends up being more difficult. So they're kind of more hesitant. So eventually you get to a point where the private sector can't create inflation, which is basically what you're seeing in Europe. No matter how low you put rates, they don't respond. And in fact, you get to the point where you get into negative rates, and the private sector, as you send them lower, they become even less incentivized to actually go and take out loans because it ends up being, it's deflationary. So at that point, it's up to the government. And up until now, most governments, apart from Donald Trump, have been reluctant to go and spend. You see Germany trying to balance their budget and saying that Italy can't go and run a deficit. Even you see in your country, Aaron, you're from Australia, right?
Mm-hmm.
Your latest guy up until before the forest fires, he was talking about running a balanced budget, and he ran on trying to balance the budget, and that's starving the system of money, and in an environment with limited private sector credit creation, it's kind of, it's the formula for lower and lower interest rates. So I understand why people think that we can't make inflation, but what they fail to realize is that if the government goes and spends, they can do it whenever they want. I look back at history and I don't know a single country that has ever collapsed because of deflation. But I know lots of countries that have collapsed because of inflation. And all you needed to do is have a change in attitude about government spending. And I think that you're going to find that we're going to be able to create the inflation that was so elusive. And this virus, I think, will prove to be the deflationary impulse that changes that attitude and encourages people to go and spend. And at first, it'll feel great, Aaron. I think that it'll do really well as the government spends, and it'll be terrific. But like all things, they'll take it too far, and we'll go through what'll feel great at the beginning will end up hurting at the end. But we're miles away from that, though. I just wanted to say I understand that road is for the hard money people will say like that's a terrible road to go down because that's where we end up, and it doesn't even matter, Aaron, if you and I think that's where we're going to end up. All I'm saying is that's where we're headed. And I think that this virus has kind of cemented that path in front of us.
Well, Kevin, I think this has been really insightful, certainly helped myself, and I'm sure many people listening to this to understand some of these subjects a little bit deeper below the surface. Is there anything else you'd like to add before we close things out here?
No, you know what, Aaron, it's been a pleasure being on with you. I just want to say thank you for having me, and I really enjoy your show, and I think you do a terrific job, and it's a great resource for traders alike. And I just wanted to thank you for all the hard work you put into it.
No trouble at all, man. Thank you again for coming back on. Anyone who's listening to this, if they'd like to follow along with your insights, I know there's a couple places they can do so. You have a podcast. You have a newsletter. You're also reasonably active on Twitter. Do you want to share those few things?
Sure. So on Twitter, it's at Kevin Muir, M-U-I-R. I write a letter, and if you want to see an example of it, just shoot me an email. The letter is called The Macro Tourist, and you can get it to it at themacrotourist.substack.com. But send me an email at kevin@themacrotourist.com, and I'll fire you off kind of a couple latest kind of copies of the different editions. And then finally, if you're interested, I do have a podcast. It's called The Market Huddle. It's a little more kind of laid back. It's a couple guys drinking beer and talking markets. And you can get that at themarkethuddle.com.
Cool. And you have a co-host on that podcast. Who's that?
That's right. That's Patrick Ceresna. I laugh about it. He cheats on me. He also is on Macro Voices.
Okay.
He's the co-host. He's the co-host on Macro Voices. And then this is our fun thing that we do on the side is we like to get different traders and drink some beer and talk markets.
Yeah. And if there's one particular episode, you've been doing it for about 1.5 years now. If there's one episode which people should start with or just check out to get a good idea on it.
So previously, our most popular episode with this fellow by the name of Jimmy Jude, who is an Merc Trader, like it's a Chicago Mercantile Exchange, we decided that he was so much fun and that the world could use a little bit of something to smile at, that we brought him back this last week, and he came back and it was a huge hit. So go check it out. It's Jimmy Jude, Jude, and he's just a blast, and it's a great taste of what the show's like, and I think you'll enjoy it.
And what episode number is that?
Oh, I don't. You know what? You're putting me on the spot. I don't actually know.
I'll dig it up and I'll put it in the show notes.
Okay, that's terrific. It's the one from March 27th.
Okay.
March 27th.
2020.
Yes.
Cool.
That's right.
All right, Kevin. Well, again, thank you very much for returning. It's been an absolute pleasure to have you on again, and I'm sure we'll speak again before too long.
Well, thanks for having me on, Aaron. It's a lot of fun.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and back. All applicable regulators, registered broker.
Everyone, this is Chat with Traders episode 193. I'm your host, Aaron Fifield, and with me is Greg Newman, who previously featured on the podcast in 2018 and was recently included in the Best of Risk Management compilation, episode 2. Greg's a founding partner and the CEO of Onyx Commodities, a London-based proprietary trading firm that's prominent in market making of oil derivatives. Now, in line with the last couple episodes that have focused on recent events, this episode covers what's been happening in oil. More specifically, Greg goes through key events and themes driving oil prices, including the virus impact, supply and demand dynamics, why the crude and Brent futures alone aren't entirely a true reflection of the oil market, how lower prices affect producers, corporates, and other large purchasers of oil, etc. So given the subject matter, I know this episode won't be for everyone. It is very specific to oil. But if the energy sector does interest you, then Greg is an incredible wealth of knowledge. All links mentioned, including a link to our first interview, episode 159, are listed in the show notes at chatwithtraders.com/193. Lastly, this episode was recorded 2nd of April 2020, and I apologize for the sound. It's a little scratchy in some parts, but overall, not too bad. Ladies and gents, please welcome Greg Newman. I wanted to reach out to you because I know there's been a lot happening in oil as well. So I'm interested to hear about sort of some of the themes which are driving oil prices, some of the dynamics that you're observing, and of course, how your firm's been trading around it. So I think probably a good starting point for this would be if we go back to the beginning of March. There was a major event where oil gapped down something around 30% over the weekend when it came back online Sunday evening. As a firm, how did you manage trading the evening oil gap down so much?
Do you know what? If I could take it back a bit, because
Feel
oil
free.
has been very, very interesting. Yeah, but we came into 2020, and actually there's a lot going on. It's been a very interesting market in oil, particularly in the last year. Going back, we had the Saudi Arabia tax, the threat of a war with Iran, OPEC decisions, and then actually a really big one was the International Maritime Organization. They enforced a specification change in shipping fuel. They lowered the sulfur cap that you could have in the oil, and it had really interesting kind of impacts on the market. I don't think anyone really expected it to have the impact it had. We suddenly had this fuel that was pricing, an end user product that was pricing way above anything else, and it was changing the way people were buying certain crudes and certain different behaviors. And actually, the way you looked at the market was suddenly very, very different. So it was a really interesting time. But ultimately, coming into 2020, the trade houses and the majors and these guys with big derivative purchasing power in the market, the guys do a lot of trades. They've done very, very well. And I think there was an element of coming into this year with a lot of confidence, and there was talk more of oversupply in the crude market, even in early 2020. And certainly at Onyx, we had that kind of view longer term. So you were starting to see the signs, but you did have this kind of these dynamics at play that were making things interesting. But I think when the coronavirus started to be taken more seriously, because, we did hear it being talked as early as December, and then January, it was on the focus for the oil market because in China, the Chinese are a huge buyer of oil and oil products, and it's really important to keep an eye on what the Chinese are doing. And because they were very impacted, and the Eastern market in general was starting to get impact early on in the year, you were starting to see the signs of corona on the oil market in the early parts of the year. But I think like anyone else, like anyone sitting at home or looking at things this year, immediately it didn't seem like a global pandemic at the time. There wasn't any certainty that this was going to become what it's become. And of course, what naturally happens is that filters through into your psychology for your decision making if you're a trader. And I think these guys that came in, a lot of them quite confident on the long side in general, done very well last year. I think they were to an element of denial, right? An element of this is probably not going to last. And it steadily became worse and worse. But then, yes, this pricing war situation happened, which has become really talked about across the world. And bang in the middle of this, we had the OPEC Plus, meaning Russia and the OPEC conglomerate. And ultimately, there were discussions about what they were going to do about the coronavirus, a clear demand slump when they wanted to cut production even more. But the thing is that these guys have been cutting production for quite a long time now. It was only ever meant to be a temporary thing. I think only 18 months initially. And they've been rolling these cuts, every 6 months again and again and again. And Russia were never really that keen about this. They did it reluctantly from what they were saying and what was being read. So I think it was just a matter of, look, we don't want to cut even more. I thought, yes, we can roll these cuts, but to cut even more is just not something they were prepared to do. And Saudi Arabia in particular saw this as, well, we need to either be protecting the oil price, protecting the supply that's going in the market, or getting market share. And so they came out and said, right, if we're not going to comply, then we're not going to let anyone else produce more than us. So we're going to produce as much as we can and then go for market share. So that's what's happened. But the really interesting thing, I think, yes, in combination, you had the demand destruction from coronavirus, but then combined with the pricing war, it was really clear that the market needed to go lower. And I think anyone really with oil market, looking at the oil market, you didn't need to have a huge amount of industry knowledge to know that this was going to be really impactful on the downside. So it was the fact that it was released on the weekend that was very, very interesting, because if you go back to last year with the Saudi Arabia tax from allegedly Iranian missiles, that took off 10 million barrels of production, just straight off the market, real oil not being able to be delivered. And that, again, is very binary up. It's very binary, a bullish thing for the market. And it happened over the weekend. So usually what happens in markets, and it's very common across all markets that are financially traded, you have a situation where something happens and then you need to react, or you need to do something if you have risk on. Either you want to trade it to try and through a strategy, or you want to get out of your current risk. But either way, there's going to be a herd type panic type situation. And the common phrase, I'm sure a lot of people have heard, is buy the rumor, sell the fact. And what that essentially means is, when it's happening right now and you don't know what's going on, there's a good kind of strategy to profit from the kind of hysteria and contagion of fear, to buy into it and ride it up. And then once the news actually comes out, be aggressive in getting out. And it could be the reverse way. It doesn't have to always be up and down, but it could be down and up. But either way, that's usually what happens when this information is fed through during the day and when the markets are open. But the markets in the oil markets, the derivatives in oil, aren't traded over the weekend. So you had a situation last year that on a Saturday, these missiles hit, and then everyone had time to actually consolidate and think, what does this actually mean for oil? And no matter where you spun it, it was not a rumor situation. It was genuine production offline, and there's going to be a genuine impact to oil. So when you came in on the Sunday evening, when the markets opened, so it's 10 p.m. UK time, it's going to be so obvious that the market's going to go up. So what happens, and the why dynamics now come into play, is that when the exchange opens, they match all the orders that have been put on as pre-orders. So you can go in and say, I want to buy oil. You can say at market, right? You can put your price in, I want to buy up to this level. And then you have the other side, which is the sell orders, and the exchange will just match them, and the market will open to where these orders are satisfied themselves. But on that time, you had mostly buying, of course, because it was so clear what was going to happen. And anyone who was long wasn't going to sell. They were going to wait, because why would you not? It's so clear what's going to happen. So the market just gapped up $10. And that's a huge thing to do, $10 just in a microsecond. And then from there, you have panic and all that kind of thing. And then it took some time to settle down. So I think there's an element of strategy there. I think you can never prove these things, of course. But in my mind, it was a very strategic thing to do, to release this news on the weekend. So you already had a demand slump. You already had quite a long market, as I was saying before. So you went into this weekend, the market long, demand starting to peter out from Corona, and then releasing all this supply on the market, or the news that you're going to release on the supply on the market. The sell orders on the weekends just, were flooded the exchange, and we gapped down, as you said, 30% in a split second. And why was that so important this time? Well, as I said, I believe the market was generally very long, or at least quite long. And so, again, if you have this happening during the day, you have time to get out of it. You can even get short if you're quick enough and you're efficient enough. Quite hard to do if you're a big player. But this time, it just gapped down. So yes, the outright price gapped down 30%, but so did all the differentials, all the time spreads, all the components of oil and the oil derivative ecosystem would just gap down. And there was no room for anyone to trade out of it. You were either short and participating in the move down, or you were long and getting hurt. And then what do? When you come in on Monday morning, say, right, we're down a lot of money, or our position's against us, but the market's moved down so much, it's not an obvious thing to then sell again. See what I mean? So it was a very difficult time, and it hasn't closed. It hasn't evened out. The market activity has been crazy. The price action has been crazy ever since, because you've got to look at it from a trader's perspective. It's actually still early on in the year. We've got to get our revenues for the year, and if we're down, we want a chance to fight back. So what do we do from here? So there's a lot of things going on. There's people trying to capture the difference between the prompt price and the forward prices by cash and carry. So what is that? It's buying a ship and filling up the ship with oil right now, storing it out in the ocean and waiting for the prices to recover. There's people doing that. So there's derivative flow from that. There's derivative flow from speculators getting short. There's buyers who, are end users who want to profit from, or want to at least capture the low prices to allow their businesses to run. So there's a huge amount going on, a huge amount of volatility, and it's really, really very interesting. But for us, the initial worry was not the price action itself, because we are trading the granular swaps and differentials, and as I say, the ecosystem around oil that's more related to the physical and the flows and geographical locations, all these things going on. That's where we're trading, and that's the swap market in general. And that has been really good market conditions. We like volatility. We're there to provide liquidity. We're market makers. So someone wants a price, people are very willing to do it and not negotiate because it's a fast-moving market. So a lot of the work is being done for us in that respect. But our initial concern was, well, God, this is really serious on a global economy side of things and operationally. Are the exchanges going to be okay? Is the clearing bank going to be okay? How's the financial system globally going to react to this? And so hats off to the regulators at the end of the day, because I think the banks are a lot more prepared this time compared with the '08 crisis, or certainly the '08 crisis. But since then, there have been issues, and it's been very hard for banks to get dollar liquidity. And I'd actually love to listen to that podcast that you said you had with that trader on the kind of Fed movements, etc. But that was our initial concern, that the functionality of the market, the trading access would go down. But actually the exchanges have had loads of contingency. They're all okay. The clearing banks are okay. And actually everything's operating as normal. So it's more about getting operationally sorted from our point of view. And as we were talking about before, Aaron, it's just been a matter of our tech team and operations team making sure there's trading stations for everyone at home and the internet connection's good, the remote server's good. And they've been absolute heroes for us. And they've really allowed us to be in the game and profit from all this violent price action and market conditions. So yeah, that's been good for us. And I think generally speaking, the market will continue to function, which, as I say, hats off to regulators and banks and exchanges all kind of prepare to this to some degree.
So what exposure did you have going into the weekend? I understand you're a market maker, and I understand that you're also trading not only the futures derivatives, but you're trading the swaps, which are more closely tied to the actual physical, etc. What sort of exposure did you have, regardless, going into the weekend?
So what we'll inevitably have is residual risk left over from taking the market flows across all the products and across all the crudes. There's many different differentials in each region. So there's products can vary based on specification, based on region, based on product. And what happens if we're trading all those together as a company, you can never really get flat. So what we're left over with is a lot of time spreads, a lot of cross-product differentials, and what we call boxed up risk. So essentially trying to keep our delta as close to zero as possible. And so what we're exposed to is just the difference between the prompt prices and the forward prices, and as I say, cross-product prices. And that tends to move less and tends to be more manageable and tends to be more flow-driven. So we might even actually hold that risk purposely to pre-position for the next time zone. So if it's in Singapore, for instance, there's Eastern flows in the Singapore-based market, and they behave very differently and have different requirements to the European. So if you know that and you trade the US market, for instance, in the evening, you can position yourself into flows or into contracts that will assist you in market making the next morning. And so that would be the majority of the risk we had going in. And to some degree, there's some speculative positions also. If you're going to preempt where liquidity is going to be required, there is an element of speculation to that. So coming in, we certainly had that kind of risk on the books. But ultimately, it's a very low proportion relative to our intraday trading. And so it's managed in such a way that even in huge moves, we're not expecting to draw down considerably. And actually, we want to be we want to be trading and able to react to these situations, because this is when the market needs liquidity most. And this is where there's really our function and service providing to the market comes into fruition. This is really where we're wanted and needed by the market. So as long as we can go in clean enough in our books and not too much damage on a drawdown basis, we're there to function. And it's just been very, very, very busy.
Does it make it difficult for you to make a market during events like this? Because as you kind of described earlier, it's like this was very clearly a sell sign. Everyone was trying to sell. I mean, is it hard for you to make a market in that condition where a lot of the flow is very one-sided? I understand that might be a bit of a naive question, but I'm interested to hear your answer.
Sure. So again, it comes back to the outright price or not. So if you want, it was very clear from an outright price perspective and outright differentials. If you've got a market that a crude differential or a product differential it has its different dynamics. It's actually more straightforward for a crude differential because you know that the crude market is being oversupplied. The refiners don't want the crude because they can't make any money. There's demand destruction. So you'd sell the outright price if you wanted to trade the outright price, and you might sell the swap differential to the outright price as well. But on the flip side, when you have a product differential, or to be fair, a certain type of crude differential as well, it's a relative value thing. It's not going to move like for like with the outright price. So actually there's scenarios where, for instance, if I look at, say, the residual fuel oil market, which is the bunker fuel, or now is used into the blending pool and sometimes to run into refiners directly. So you've got this market which actually is decorrelated. It's inversely correlated, to Brent futures. So if Brent futures go down, the differential goes up. And there's a number of reasons for that. The first one just being that's just market dynamics. If enough people buy into that style, then that it does tend to be what happens. And when that correlation breaks down, then that's a sign that something's changing, that kind of thing. But ultimately it comes down to, or it could come down to, an end user needs to buy, for instance. So they want to buy a product, a derivative, let's say an airline, they want to buy jet. So they're going to buy the jet fuel outright price. And they're not so worried about the jet differential to the Brent futures. They just want to buy the jet. So if they're in there buying and there's a lot of flow buying there, but there's a huge amount of flow selling from the Brent futures, then you will naturally see that jet fuel differential to Brent future widen and actually go up, not down. So that's an example of how it's in the swaps and diffs and time spreads. It's not linear. It's not completely correlated to the outright price moves. And if you take that one step further, if I again use jet fuel as an example, the difference between jet in Europe and Singapore will not be correlated to Brent futures at all as well. It will be more dependent on the shipping costs because it's pricing in the differential or pricing in the economics of moving jet fuel from one region to another. And you can go again and again, the difference between a jet specification in one area to another, in Northwest Europe to Mediterranean, it gets more and more granular the more you look at the products and the different types of crudes. So that's where we're sitting. And again, that's just the products themselves, but actually the time structures. So if we're trading in the forward curve, we're trading, as far as 2 years out, it's going to be very different, or not correlated at least, to Brent futures. There's going to be different people doing different things. There might be people buying the time spreads because they need to lock in this cash and carry, this storage play I told you about. There might be an end user, there might be a utility who wants to buy in a very specific area, and all the flows will move around depending on that. And ultimately, everything is linked, and that therein lies the skill of a market maker. They're trying to bring flows from different areas, from a different products, to provide liquidity in different areas. But if you avoid the outright price, there's still a huge amount to do. And as I say, not correlated with the price of oil outright on an outright basis at all. Does that answer your question? It
does, yeah. I understand how you're spreading your risk across different contract expiries and different products, etc. I mean, that's it in a nutshell, yeah?
Well, it is, but it's also the fact that it's not about just, okay, yes, the oil price is going to go down, and generally the prices for all oil and oil product is going to go down, but the differentials within that and the different time regions, they're not going to move on that basis. Do you see what I mean?
Yeah.
That's the crux of it, and that's why I say there's a lot of need for people to lock in these differentials. You might be a buyer of jet fuel or say fuel oil in Europe, and you want to bring it to Singapore, and you're always doing that. Therefore, you need to buy the difference between the two contracts, and so there's loads of these different types of trades and strategies and hedging to be done. So there's all these different types of price movements that aren't correlated to the oil price. That's essentially what I'm trying to say.
Okay. I might just ask you to explain the terminology for the word differentials.
Sure.
I think there might be a few people who get caught up on that.
Okay. So a differential, what I mean there is again, focusing on the swaps. So everything needs a benchmark, right? Everything is traded relative to a benchmark. So you have the Brent futures as an example, and then you can then determine the Brent swaps from the Brent futures, and the Brent swaps, you will trade differentials to that. So for example, let's say dated Brent. So dated Brent is the North Sea, is representative of the North Sea crude oil market, and that will have a price. And that price difference between the actual underlying North Sea oil versus the Brent swap is what we call a differential. And then you can do that with many, many products. So for instance, you could say, as I said, the jet fuel in Northwest Europe, that will be a differential to Brent swap as well. You could have a differential to jet fuel to gas oil. And what it essentially means is the stable interactions that the physical guys use and the derivative players use to trade around. So there'll be liquidity in these key diffs, and that's where you need to focus to get your liquidity. So for an example, if you're a Mediterranean jet fuel buyer, you'll actually focus on the jet Northwest Europe differential to Brent swap, because that's where the liquidity is, and then you'll then manage your Mediterranean versus Northwest Europe exposure. So it's all about essentially the contracts that link the contracts. That's what a differential is. It gets very granular, but that's the way we describe it. And the differentials will reflect what's going on in the regions. So for instance, again, that dated Brent example, if Brent swaps are a function of the Brent futures and a lot's going on in the Brent futures, a lot of speculation, etc. But then the dated Brent differential to that will be more reflective of the underlying physical. So if it's very weak, it's showing you that the prices for the benchmark are too high for the physical players to actually commit to. They're only willing to commit to a lower price. So that's essentially telling you the information that it's weak in the market. And that is how we generally look at markets, even if we want to know what's happening with the outright market. We want to know what are the differentials doing, because that's the real signals of what the physical market is doing. And actually, it's very, very relevant, that kind of analysis right now. So remember last year we talked about trading what you're trading. Do you remember that?
Mm-hmm.
And what that essentially meant, what I was trying to say there was be careful about your expression or your view and how you're expressing it. So right now it's very interesting because Brent futures, as an example, have been very weak since the move down on that weekend a few weeks ago that we talked about. But actually, since then, it's been very difficult to break below $25 per barrel. And that doesn't really make much sense in a supply and demand basis. But this is the key thing. The futures aren't a reflection of supply and demand. They're just one price. The physical oil prices, i.e. the differentials, the physical oil prices that are traded at differentials to the benchmark are all very, very, very weak. And they're reflecting the true price of physical oil, and they can continue to move down. But the Brent futures market can stay where it is because it's only one derivative. And I think this is generally not really understood too well, which is that if in order for Brent futures to reflect supply and demand, it would need to perfectly mimic the physical market. So what that means in a kind of overarching sense is the only way for Brent futures to reflect supply and demand dynamics of global crude production would be if every single producer of crude oil sold the Brent future as a way to hedge their production. And conversely, only if all the consumers hedge 100% of their consumption with Brent futures. And then any difference between the two would then indicate a supply and demand difference. But of course, we know that doesn't happen. One, the global producers of crude and consumers of crude, they don't 100% hedge. I mean, that's for sure. There's a lot of governments that's just too big. They don't even bother hedging. So that's the first thing. Second thing is that those who are hedging, they're not going to use Brent futures exclusively. In fact, very rarely are they going to use just the Brent futures because it's not reflective of their actual physical. They'll buy a swap or sell a swap in their particular region. So they might do dated Brent if they're North Sea or European crude. They might do Dubai swaps if they're Middle Eastern, because it's much more reflective. So there's no way that you could justify that Brent futures are reflective of supply-demand basis just purely on a hedging point of view, because they don't balance out. But on top of that, the volumes that trade in the Brent futures market are many, many times the underlying global crude production. So actually, what makes up the majority of the market is speculation and buying and selling derivative power from trade houses, majors, hedge funds, macro players, foreign exchange traders. So that's what moves the Brent futures market in particular. So it's quite confusing for people when they say, well, why is Brent futures still doing this when markets are so weak and all the physical prices are so weak? And yes, the first clue that the market is weak is that all these differentials that we're talking about are very low. But it's not a great reflection to say, or it's not a great way to express your bearish view by selling Brent futures at the moment. Why? Because everyone who is participating since that weekend, it's been such a clear thing that it's a sell, that you've got a situation where the market is heavily saturated short. And if the market's heavily saturated short, then there's no one really left to sell in decent volume. And so all you're left with are opportunistic buyers. So end users who want to buy to capture the low prices, like airlines and shippers, etc. Or you might have guys who want to short cover their short positions. And the way to know and get signals that this is going on is to see the reaction to headlines and physical information. So for an example, just yesterday, we had the Department of Energy in the US release their statistics for their crude stocks, and it was expected at 4 million barrels. And you could argue that these things are never really that accurate. But ultimately, you would say that the realms of possibility should be 1 or 2 million barrels around that number. And actually came in at 13 or more than 13 million barrels stock build. And that is incredibly bearish, or more bearish information. And the market went down 25 cents and then recovered by the end of the day and actually went up on the end of the day. And that's not really surprising if you know that the market, A, is very short already. B, this kind of physical information is probably already priced in. And so it makes it very difficult, very frustrating for those trying to reflect a bearish view of oil with the Brent futures price. However, if you trade with a differential, like we're talking about, or a time spread, there's actually a very high chance that this is going to trade with supply and demand fundamentals. And the reason being is because the swaps that ultimately price out and are valued to physical oil, a real proportion of physical oil, depending on what the swap contract specifications are, you can't fight the supply and demand. It will price where the physical prices are trading. And so no matter how much you buy, if you wanted to push up the market, it doesn't matter because it's going to settle to where the physical is. And that makes it a lot less able to be pushed around by speculation. And you hear guys on CNBC and generally people talking about the macro market saying the oil market is manipulated and this and that. But what they mean is the oil market doesn't move like for what's going on in oil. But as financial traders, and this is the same for any market, you need to understand market psychology as much, if not more, than the underlying supply and demand, because you've got to know the participants who are trading and the traders that are able to influence the price by their buying and selling volume. What are they doing? And it's completely clear that everyone's short. So I think it's quite worrying for, I think traders should be careful speculating on the outright price right now. They should be doing it with an expression that really does marry what they're trying to express versus what they're expressing. So this trade what you're trading thing I talked about last time, it's still very, very, very important. And another example is the US crude. You can trade on a retail basis. A lot of people can get access to the WTI, the US crude futures. But that's even more dynamics at play because you have US flows, yes, but actually it's reflecting the oil of Cushing. So actually Oklahoma, which is 500 miles away from the waterborne or able to export that oil to the open market through ships. So you've got all these pipeline dynamics to be aware of, and those hedging their pipeline dynamics, arbitrages, and there's just so much going on that you need to be aware of all the factors and know what you're expressing. If you sell WTI futures, you need to be aware, or buy WTI futures, you need to be aware of not just who's participating and why, but where it's the underlying basis and the dynamics, the physical dynamics at play, et cetera, et cetera. So it's just to reiterate that point, really, but it all comes together with this, what you originally asked, was what differential actually is. And it's essentially the reality of the physical oil market, the prices that need to benchmark against something. Because it's not useful to say, if you're in West Africa or somewhere not close to oil hubs like Dated Brent or like Cushing in WTI, it's very difficult for you to say, right, let's agree on an outright oil price. Because where you're going to come up with that number, it's much more straightforward to reference a benchmark price like WTI futures, like Brent futures, and then you will then determine value of your oil depending on the difference in the regions and how you value that difference in the regions and how you difference the value in the specification. So the West African example, if there's a West African crude producer, they will look at what the Dated Brent market is doing, what the Brent futures market is doing, and they say, well, we think our oil is slightly different to that market, and we're going to value that at plus $1 because we think it's a better quality. We also know that it takes a fair amount of time to bring the oil over. You need freight costs, etc. So we're going to incorporate that into the price as well. And it's much easier to negotiate the price basis a benchmark than it is an outright basis. So that's why they're so popular and used so much. But consequently, because they're the ones, these differentials are actually the reflective of the prices that are being negotiated in the physical market, it's therefore much more reflective of what's really going on in the underlying physical. And I actually talked about it this morning, did a post on LinkedIn about how, yes, a lot of people are talking about how the US oil prices are very low, the actual physical oil prices for shale, etc., are very low, and therefore there's going to be production cuts. Okay, that's quite a myopic view. That's anyone can kind of see that. But then what's next? Well, if you've hedged and you've hedged correctly, i.e., with the actual swap that's reflective of your physical, then that's the whole point of hedging. You can keep operating because you've locked in the cash flows, right? You've sold what your forward production, and yes, you're producing and making a lot less money than you were on your physical, but that's been offset by your derivative hedge. So that keeps them in the game for longer. And there's those kind of dynamics at play. So you need to say, okay, well, how do I actually get evidence for that these producers in the US are slowing down? And again, the swaps market will tell you that. So the LinkedIn post this morning was essentially saying, right, the last 2 days, we've seen the US grade, we call it US grade domestic crude market. So it's the differentials in the US market to WTI futures. And those differentials, and they're the Gulf Coast, different specifications in the Gulf Coast, in Houston, in Cushing, in the Midlands. And so you look at all these differentials, and they're all correlated at the moment. They're all strengthening. And that is a great signal that you don't need to know who's doing what. You just know there's a lot of flow pointing upwards, which suggests, and the evidence suggests, that there is genuinely production cuts. And because it's traded in the future, because these differentials, a lot of them are traded forward looking, it's actually reflective of decisions being made. So traders are clearly anticipating that the US oil production is going to go down, and therefore the prices should recover. So they're reflecting that in, say, 1 or 2 or 3 months forward in the swaps market because they're preempting it. So you don't need to know which specific trader is doing that to know that, or if everyone's doing it, there's clearly something going on that I don't know, which makes sense because I'm not a physical player, I don't have shale oil production, but I'm seeing this market react that way. That is the evidence you need to know that, yes, production really is slowing right now in the US. And there's a case to be said that perhaps something's going on even deeper, that there could be agreements being taking place. You just don't know. But what you can do is marry what's actually happening in the physical market through the information and swaps, and then start to express it how you want. Does that make sense? And that's why differentials are so important.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs. And short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's Capital.
There you've been speaking about the actual oil producers themselves. I'd be interested to know or hear you talk about what impacts the drop in the price of oil, how that's impacted other industries, for example, maybe airliners and other companies which are major purchasers of oil.
So with companies, it's actually typically, well, we call them corporates. You know, they're not oil traders. They just have requirements to purchase oil and oil products to run their business. As you say, for instance, an airline. And typically, when you get the price of oil lower, it's great for them. It's a windfall. You know, that they're able to either just buy cheaper jet fuel right now in the prompt, or they're able to then look at the swaps market, the forward market, and say, right, here's the levels that we're going to be able to buy jet fuel in the future. If we hedge right now, let's do it. And that allows us to plan, you know, in 1, 2, 3 years forward. And it's great. So they can know their economics, and they're ultimately going to make a lot more money if they've got lower costs. The problem is this time is that it's also coupled with a demand destruction from the coronavirus and planes being grounded and airlines going bust. And it's a shame, because the way it typically works is you have a hedge. So if you haven't hedged, then the airlines will be able to buy cheaper jet fuel. But also, if they have hedged in the past, then they'll actually be losing money on that hedge, which should be offset or should be mimicked with the physical jet fuel they're buying, which is then cheaper. So they're losing money on the hedge, but buying cheaper physical oil. So net on net, they're just kind of flat, depending on how much they've hedged. That's typically what happens. But this time, they aren't getting the ticket sales. There's not been an increase in ticket sales, and there's just been a complete demand destruction. So not only are they losing money on their hedge and have a negative mark to market on that, they also don't have any ticket sales to then justify buying physical jet fuel at a lower price. So they're just losing money on lack of ticket sales, and they're losing money on the negative mark to market on the hedges. And the reason why that's so important is because they might be able to withstand the negative cash flow, but it's the fact that they need to actually fund that cash. In these extreme scenarios, banks aren't willing to leave the credit lines open without some kind of funds. So they now are needing to transfer real cash over, which is very much needed right now to stay solvent. They're needing to, as per agreement, transfer this cash over to the banks or the credit lines or the exchanges, depending on how they've traded. And they're losing twice. They're bleeding their cash. They're not able to profit from the low prices, and they're losing money on their hedges. So it's a very, very difficult time for airlines at the moment. That said, if they can consolidate, unwind their hedges, bleed the cash, so stop the bleed in the cash flow, and kind of minimize operations and consolidate, they can actually look forward. And if you think you're going to be flying in the future, which you would expect, as we talked about just before, Aaron, maybe 6 months is what been quoted for things back to normal. Whatever it ends up being, you've got to have some kind of opinion on what you're going to be able to do in the next year, 2, 3 years. And with oil prices this low, it's still a good idea, a very good idea for oil end users like airlines who need to buy jet fuel to forward hedge right now and lock in these prices at this low level. Because if they do that, as and when we come out of this situation, you might get a big recovery in oil. There might have been an agreement made with OPEC at that time, and you would have been able to lock in these historically very low prices, which are very appealing on a historical basis relative to your costs. The oil price of oil fluctuates hugely, and it can be the difference between doing well in an airline or doing badly. So I would still, we have a consultancy arm now in Onyx, and we're definitely pushing for airlines to consider this and at least try and hedge something in the forward production. Albeit, yes, not right now, because there's so much uncertainty, but you would expect in the next year or two to be able to get going again, and the prices are still low for the next year or two. And that's what's going. And that's the same for shipping companies. Road freight. Anyone buying any oil product is exactly the same. But again, the on the flip side, the producers. So those wanting to trade equities in US oil companies, it's actually really important in these times to look at their hedging. And I think the public companies, they'll make that public, so you can know the percentage of their production that they forward hedged. And a lot of these shale oil producers, they actually only get lent money from banks if they have committed to a hedging program to lock in their forward oil prices. So if you look at that and you can see that they're quite well hedged and they've got some decent cash flow, then they're well positioned to at least sustain for a short period while this goes on. And if and when, as and when oil prices do recover, they'll be in a strong position to maintain solvency. So the ones you want to look at are the ones that didn't hedge. If you're looking at companies that are going to continue to go lower, you'd want to look at the companies that didn't hedge, have no protection on these low prices, and of course a lot of debt, etc. The only other thing I'd say on the company basis is the refiners, those actually refining the oil. Again, typically refiners will do quite well in low oil price environments because it generally, historically, has been, in the last 5 or so years, the sell-offs have been led by an oversupply of crude. And if there's an oversupply of crude rather than a demand destruction, then that means you can buy crude, cheap prices. And if you're strategic about it and you have access to the world's different oils, then you can increase your refinery margin, the amount you're selling your refined products for versus the amount that you're buying the crude for. And generally that's quite good for refiners. But as I say, this time it's actually been led by both a supply increase and a demand decrease. So if you're going to look forward, you need to be tracking these refinery margins. So if we do get a return of demand, we still have a crude oversupply at the moment. So in order to figure out how the oil market's going to move forward, what I expect to see is you will know when the demand's returning in the oil market by the refinery margin. So you'll see that refiners are starting to generate profits. And then when that's the case, then there'll be more demand for certain crudes. And then you can start to piece things together that way. And certainly if you're looking at a company who is just a refiner on an equity basis, then once the demand returns, they're actually going to do very, very well. In 2014, when we had the big sell-off last time, and 2015, they had an absolutely amazing year, refiners. The refinery margin, despite the oil market on a crude supply basis being very low, they did very well in terms of capturing the value in between. So that's something to look out for. And I know, again, it's coming back to how do you access that if you don't have all the swap market information? Well, that's what we're trying to do at Onyx. We're trying to provide more transparency. What are we hoping to release in the next 2 to 3 weeks is the Onyx Price Hub, whereby we're going to provide live prices for refinery margins, for jet fuel, and these differentials we're talking about, so people can get more transparency and clarity into what's actually going on in the oil market. I think it'd be very useful, particularly those who don't typically have access, because it's a very difficult thing and sophisticated thing to have access to at the moment. So that could be really interesting. But what I would advise anyone speculating in oil futures in particular is to track the refinery margins and the differentials as best you can. But as I say, Aaron, I hope to have that website up and I'll give you the details so you can release them if it's easier.
Yeah, for sure. I'll make sure there's a link to that in the show notes. And by the time this episode comes out, there's a good chance that if it's 2 to 3 weeks, that'll be available now for anyone who's listening.
Another way to track that would be through our LinkedIn. We have our Onyx group. We have our trading arm, Onyx Commodities, and Onyx Capital Advisory is our advising arm. We're releasing information all the time. So if you track that on LinkedIn, there will definitely be information once that's released of how to access those prices.
Okay, cool. Greg, I was going to ask you, just to wrap things up here, what are the key fundamentals which we would need to come into play to drive oil prices higher again and to recover? I think you mostly answered that already towards the end of that last question, but I might just ask you again just to take us out here.
Yeah, sure. So I think the first thing to note is that the futures prices, again, and even the swaps to some degree, they're traded on forward physical prices. So there's always an element of thinking, even if that what I'm trading is related closely to physical, the traders who are trading those contracts, they still have to have a interpretation. What we're going to need to see is either a deal made in the OPEC and Russia, and actually the US are allegedly getting involved in those discussions now. We need to see a deal made there, because that will give confidence in speculators on the forward price. We need to see essentially some confidence returning for speculative buyers. And I think that's really important, because, as I say, the speculative market drives Brent futures so much, because there could still be a situation that even though we do get a retracement in the Brent futures prices, the differentials may stay weak, because just because a deal has been made, or just because there's been something happened in discussions, doesn't change the fact that the market's heavily oversupplied and we're completely full globally of storage. It doesn't change that. So what you might get is everyone looking forward will be trading the outright price, and they will speculatively buy that, and that will drive prices higher. But then the differentials will still remain low, and you need to be careful, because the market may get overexcited and overextend on the long side, whereas the physical market's still lagging. And again, you can get that signal from the time spreads and the differentials. And so then you would see probably a retracement, or at least some volatility at that point. But to get a true underlying physical recovery, I say if and when a deal is made to taper this kind of considerable oversupply in crude, that will then allow at least some storage to slowly be unwound. And when the market's full of storage and full of supply, at some point it gets to the point where no one's left to buy physical oil. So if you stop this real attempt to just pile the market full of oil, then that will at least slow that happening and may start to release some oil out of storage. But as I said, once the demand returns, which you'll see in the refinery margins, that will be when the demand destruction that we've had, which is I think Trafigura said recently, they reckon it's 30 million barrels in March. Vitol said 20 million about a few weeks ago. Either way, you're going to get that returning to the market. So you're going to get, and you'll see that in the refinery margin turning positive. It's negative at the moment, so the refiners can make money. So they're going to go out and buy the crude. So you'll have a deal made which stops there being oversupply or serious oversupply. And you have refiners willing to buy more of the crude. And that should start to tip the market in balance. And the most important thing I will always say is, you can't look at it like, okay, so this is what the state of the oil market is right now, therefore I'm going to trade it. It's always forward looking. What do people think is going to happen in the next 2 to 3 months? If you're thinking like that, it will then make sense when the market moves ahead of you. So you might say, well, yes, I'm aware that refining margins are strong, a deal's been made, but the physical market's still really weak. Yes, but everyone's preempting the prices in the future, and that's what's going to drive a futures market. It's a lot on speculation, so you've got to be really careful. And it goes back again to how you express your view. If you want to express it in a certain way, and you need to choose the right contract and choose the right expression, which you can do with oil. So I think in a nutshell, that's what needs to happen. Confidence returning, deals being made, and real refinery margin increases.
Okay. Well, Greg, it's been awesome to catch up with you. Man, you're just an absolute wealth of knowledge when it comes to all things oil and energy. So I appreciate you coming on again and sharing it with us and going into such great detail on these subjects. I think it's going to help a lot of people who have an interest in this sector for sure.
Absolutely. No, happy to come back anytime, Aaron. It's great.
And if someone does want to find out more about yourself or Onyx, where is the best place to go right now?
I think we're utilizing LinkedIn quite a bit right now. We've got our advisory team active on it daily, and myself as well. I'm releasing videos and my thoughts on market dynamics. So if you just Greg Newman on LinkedIn or follow one of our companies, that the Onyx Capital Group, Onyx Commodities, Onyx Capital Advisory, there's lots going on there. We're releasing our opinions, what's going on, but also, as I said, links to the price hub that we want to provide transparency and things like that. We're really trying to provide a platform for oil derivatives to increase the accuracy relative to physical, increase the transparency for guys to know more about what's going on, and ultimately liquidity. That's what we do. So we're trying to grow that out, and you'll see more and more of that as we go forward. And as I say, LinkedIn is the best way. We have a website as well, but I think LinkedIn is probably easier for everyone these days.
Okay. And I will also mention you do have a podcast, or Onyx has a podcast. I think you started it last year, and there's been a couple episodes come out this year. Is that something you're still actively doing?
Definitely. I mean, it's been very, very busy, and ultimately we don't have any dedicated. The people that do it are, the people that work day in, day out. So we do try to get it when we can. Obviously, time's been very busy. It's been difficult to release one recently, but certainly we'll continue to do that. Absolutely. And what we're really enjoying with that is, yes, our opinion on how things move and what goes on, our philosophies in the market, etc., but also actually what it's like to be a trader, or what it's like to be anything at Onyx. We even had an HR. Our head of HR was talking not so long ago about how it is to work at Onyx there. And so, there should be lots on that podcast for anyone interested in a career in finance in general. It could be quite interesting.
Yeah, and it's available pretty much on all podcasting platforms.
Spotify and Apple.
Okay, well, they're the two main ones.
Yeah.
Excellent. All right, Greg, let's leave it there, and we'll catch up again soon. Thank you very much.
Great, thanks, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with more features. Join Tasty Options and VC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey everyone, what is good? Welcome to the show. Here we are for episode 194. Joining me is Liam Vaughan, finance author and senior reporter for Bloomberg. Liam's latest book is Flash Crash, which tells the story of Navinder Singh Sarao, a London trader living at his parents' house who made $70 million from his bedroom and was later accused by the US government of playing a part in the 2010 flash crash. Just for anyone who is unaware, this was a deeply perplexing event in which the US stock market one afternoon plunged approximately 9% and then almost completely rebounded, all in the space of just 30 minutes or thereabouts. Liam sent me a copy of the book beforehand, and it was hard to put down. Truly, he's done an amazing job of the book, and although in this episode, Liam does speak about many interesting moments from Nav's life, from starting out as a prop trader in 2003 through to when he was extradited to the US in 2016, believe me, it is only the tip of the iceberg. The story runs much deeper. Go get yourself a copy of the book. It's available from May 12th, 2020. And if you punch in chatwithtraders.com/Liam, Liam, that will redirect you straight to Flash Crash on Amazon. Again, that's chatwithtraders.com/Liam. All right, please enjoy the episode. I knew a little bit about Nav, like I followed the story I wouldn't say very closely, but with a little bit of interest. But I mean, obviously, learned so much more about it from reading the book. So let me ask you this question just to get things going here. What compelled you to actually go to all the trouble to speak with all these people and write a book about Nav and the flash crash and the events surrounding it?
Yeah, so I've been a financial journalist for about 15 years. And for the last few years, I write predominantly about white collar crime. A lot of the time you're writing about people who, are very well educated, have gone to investment banks like JP Morgan or UBS and end up getting in situations like, the LIBOR scandal or the rigging of foreign exchange rates, things like that. And they're pretty interesting, as a journalist, but the people that you're writing about tend to be of a certain type, or you get the other end of the spectrum, which is like straightforward con artists, of which there's a few in my book. And they're fun stories as well, because these people are just really fascinating characters that they're willing to lie to people and to sort of steal their money, and that's interesting, in the way that they spend it and stuff. But Nav was just totally unique, really. He was just such an odd and unusual character, came from a completely different world, and also just the fact that he was a day trader. He never really had any dealings with any major financial institutions. Was very much on the kind of outskirts of the normal world that Bloomberg would write about, and yet he was just brilliant. And there were so many unanswered questions. Like when I started looking into the story, there was just so many unanswered questions. Like, was he really a good trader? Was he just a cheat, or was he actually brilliant in some ways? And did he really cause the flash crash? Because there was so much dispute around that. And as a writer, one of the things you look for in a character is somebody that divides opinion and that is got nuance. And that's the thing about Nav. It's like, if you ask somebody, they might tell you, listen, the guy was cheating, he was spoofing, he knew the rules, he did it anyway, there's nothing brilliant about that, he deserved what was coming to him. But then you ask a lot of other people and they'll say, look at the markets, look at the way that HFTs operate and make money, and you get a guy like Nav who finds a way to fight back, and he's really, really successful. And they consider that as kind of amazing, even if ultimately it was illegal. So he had everything. And then obviously there's all the stuff that everyone knew straight away about how he never spent any money, and he always wore a tracksuit, and he drove he used to tell people he had a Lambo, but it was actually a bright yellow bike with a Lambo sticker on it. And it's just a really funny character.
Yeah. I was thinking about what sort of questions I would ask you last night, just doing a little bit of prep for this interview. And it was really tricky because in some ways, I don't really want people to get too much. Like, I want people to read this book because it was really good. I feel like we'd almost be doing a little bit of a disservice by giving too much away. So there's a few points, of course, which I'd love to get in. But yeah, let's certainly save some for the book. So this is not going to be the comprehensive Nav story, but Nav started as a trader at proprietary firm Futex, which was in London, I believe. And I actually had Dan Goldberg, who was a partner at Futex, on the podcast like years ago. What year did Nav start trading at Futex? And just tell me a little bit about the kind of environment at the time when he came into the firm. Was there anyone sort of influencing his trading? Was he left to his own devices? Did he pick things up fairly easily? Like, what was that? What were the early days at Futex like for Nav?
Sure. So he joined in 2003. It was actually called, I think it was called Independent Derivatives Trading at that point, and they changed their name later. And it was a really interesting time in the sort of evolution of financial markets, because futures trading had recently started to kind of migrate from the pits, really. Over a long period of time, but particularly in the kind of late 90s, all the pits are closing, and increasingly futures trading is moving and migrating onto screens. And at that point, you get all these kind of prop shops and arcades that spring up. And Nav had recently done a degree, kind of pretty average university in London, in maths and computer science. And then there was an advert that was placed in a local newspaper. It was like, traders required, must have determination, I can't remember the exact criteria. So he applied for an advert like lots of other people and got invited down to quite a modest office, which was above a supermarket, in a place called Weybridge, which is about 45 minutes outside of London in suburbia. And he was one of the second group of intakes that they ever took on. And it was run by a guy who's a pretty colourful character himself, called Paolo Rossi, and Dan Goldberg was also one of the sort of management team, and they were sort of ex-life traders from the pits, sort of East End geezers who had, particularly Paolo, had all this success in the pits and saw an opportunity to hire people. But obviously in the pits, the type of people that you were hiring tended to be, big guys, people with big personalities that could sort of handle the hustle and bustle. But when you're talking about trading on a screen, it's almost like a different, it's the same job, but it's a different skill set. And for that, people like Nav, who have got like a photographic memory and all these just innate math skills and ability to sort of process data and information very quickly, and almost like computer gaming types as well that are very nimble fingered and stuff. Like it really suited guys like that. So Nav was one of the very first people through their door, and it was a bit of an experiment at that point in time. And the impression that I got of the place was that it was a bit rough and ready. That the personnel would come and go, and that the training was sort of a mixed bag, but also it was really fun and exciting time because everyone there was really ambitious. They were all kind of young and all wanted to make it as traders, so they were all kind of helping each other. At that point, it was predominantly focused on trading index futures, and the main sort of strategy that they were doing was kind of scalping and very short-term trading, as opposed to any kind of fundamental analysis or anything like that. I mean, by all accounts, Nav, he didn't immediately take off, but he was good and he was very patient, and he had what a lot of people don't have, which is amazing focus. So he could sit there and watch the ladder without placing a trade patiently for hours and hours at a time and pick his spots. And he accumulated a bankroll pretty quickly.
Yeah, it seems like from reading the book that risk-taking was something quite well suited to his personality. Would you agree?
100%. Yeah, everyone you speak to was just completely amazed by his ability to just keep upping size and continually take on more and more risk.
And in doing so, it sounds as though it made management a little bit nervous at times.
There's a lot of anecdotes about him sort of butting heads with the Rossies and stuff, because he constantly wanted bigger and bigger limits. And they were in a bit of a quandary because on the one hand, the whole business model was kind of predicated on finding people like Nav that could get to a big enough size. And then he was obviously paying a percentage of his profits to the firm. So they wanted him to get big. They wanted him to be profitable. But if he got too big, there was a kind of risk to the actual existence of the firm. So it was a sort of balancing act. But he got incredibly big very, very quickly. And part of, you could see that in the way that he is, because money just didn't really mean anything to him other than as a way of keeping score of his trading improvements. So he didn't buy fancy clothes. He bought a moped that he used to drive into the office, and he apparently used to fall off it all the time, and used to sometimes come into the office with his helmet still on his head. And if me or you are doing it, Aaron, suddenly you've got a mortgage to pay, or you've got debts to pay off, or you've got your family to consider. But Nav just didn't really have a lot of that stuff. So if he lost a huge amount of money, it didn't really make any difference to him. He was living at home in his parents' house. He didn't really have any desire for material goods, and so he would lose huge amounts of money one day, and nobody would even know about it because his demeanor just didn't really change. And as a trader, you tell me, but I would imagine that is a huge, huge asset to have.
Yeah, the mental game is a huge part. I mean, majority of traders will tell you that. So what products was he trading? You did mention index futures. Was he trading index futures the whole time he was there with Futex?
Yeah, so he started out trading a few stocks before he even joined Futex. That's how he kind of got into trading. And then when he got there, he was trading index futures. I believe it was predominantly FTSE at that point, FTSE futures. And then he kind of almost outgrew that market. Like he got to the point where he was trading hundreds of lots. And so he took a decision that he wanted to get into a bigger market where his trades wouldn't be noticed as much, where they would be absorbed by the market more easily. So he switched to S&P E-minis. So at that point, he starts coming into the office at 1 o'clock, 2 o'clock, and trading through through US trading hours. And that was his bread and butter thereafter. Like he did trade other things. He traded the DAX, and there's a good anecdote in my book, and I'll let your readers find it for themselves. But he found a really good opportunity to trade the DAX, which has got ties to another sort of notorious financial rogue trader. But most of the time, he was trading S&P E-minis.
Okay, and what did he build his bankroll up to while he was at Futex? Like by the time he came to leave there, how much cash did he walk away with?
So he left in about 2008. He'd basically sort of outgrown that sort of model because he was so successful that he was just giving away too much money to Futex, and he was paying commissions on his round trips. And if you're making at that point he was making say $50,000 to $100,000 a day on a good day, he's giving away $5,000 to $10,000 just in commissions. So he sort of got fed up with Futex, and he ended up leaving in 2008 and went somewhere else. And at that point, he had about $2 million built up. But yes, very quickly after leaving, he had his best year during the 2008 financial crisis.
Do you know what he made that year?
Yeah, again, like I sort of detail the biggest trades of his career, if you like, and one of those that I talk about in the book is in November 2008. I think it's the S&P 500, maybe it was the Dow. Was it a record low or maybe a decade low because of everything that had been going on, the collapse of Lehman and all that stuff. And then he decided that he would just take a long position. Unusually for him, he wasn't scalping. It wasn't a short-term position. He just went very big, long, and he timed it perfectly. And over the course of the next week or so, he kept adding to his position. And I think US markets went up by something like 19% in a week. And his bankroll went from like $2 million to $11 million. Yeah, over the course of that year.
That's pretty serious.
Amazing. And there's a great quote in the book from somebody else that was sort of sitting near him at the time. And they were sort of saying, a lot of people think it's gambling, but it's almost like the opposite of gambling, because he knew, because all of the press at the time was talking about the fact that the US were going to have to initiate these bailouts and that, it can't be allowed to continue. And so the writing was on the wall. And the analogy that they use is like having two aces in poker. Like, that the market's going to have to go up and everyone's talking about it, but have you got the balls to put everything you've ever earned into that trade? And that's exactly what Nav did. And so he really reaped the benefits, and that set him up to then become the trader that he did.
Yeah. And again, that just sort of goes back to his ability to just take on a lot of risk.
Yeah.
I made note of there was I think it was a quote from Nav, or maybe someone had mentioned it to you, or it came out later in the trial, etc. But something along the lines of he made the bulk of his wealth in no more than 20 days, spread across his trading career. I thought that was really interesting and something worthwhile highlighting, which kind of ties in here.
Yes. Yeah, so Nav's strategy was principally to go short the market in a falling market, and then get out quickly and keep getting in and out, during highly volatile periods when markets were falling. So if you look, he made his first million was in, I think it was January 2008, during a period of real turmoil. Then in November 2008, obviously famously, during May 6, 2010, in the flash crash, he made $1 million that day. And then he had his best day in August of 2011. And again, it was like a record fall in markets. Like markets had fallen 5% in a day or something. And he made, if you can believe this, he made $4 million in his bedroom in a day. And one of the things we haven't really talked about yet, and to be fair, we should talk about, is that it wasn't just that he was sort of brilliant at scalping the market, although he was brilliant at doing that, but he also, by 2009, 2010, had started on this route of really majorly spoofing the market as well.
Right. Let me just jump in here because that's something I definitely want to get into. But I did want to ask you a question before that. And it was almost like, from reading the book, it seemed like there was a pivotal point where Nav kind of changed a little bit, where he became convinced that he could identify and he was seeing other market participants that were just blatantly cheating in the market. Can you speak to that a little bit?
Yes. I mean, that was, for me, it was like an amazing find because that had never been talked about. Nav had never talked about it. It was never anywhere. But I managed to track down that he had an account on one of the major trading forums. And he's quite funny on there. Like you'll see in the book, but he's a pretty sort of cheeky, kind of like borderline offensive character to other traders. But at some point in 2007, he basically puts on this trading forum exactly what he thinks of the market and also exactly what he plans to do about it. But it's quite amazing to actually see it because it's 2 years before he even sort of built the machine, if you like, the algorithm that he would go on to use to sort of spoof to such devastating effect. He sort of lays out on this forum his plans to do exactly that. And if anyone was really paying attention, maybe they could have stopped him. But
yeah, let's speak about the software that he had developed, because this is kind of where the spoofing, I think, began to come into his trading career, if you will.
Yes.
Tell me a little bit about the software that he had developed, his intentions in developing it, and also, if you could, this is something I found particularly interesting and was quite surprised to actually see this in the book, was the actual functionality of that software he had developed. Like there were several kind of triggers that did certain things. So if you could just describe some of the functionality of the software he had developed and his intentions in doing so, that would be interesting to hear.
It sort of evolved over time. The first sort of iteration of it was something that the US authorities would later call a layering algorithm. And it was pretty straightforward. What it would do is it would place large blocks of orders, like you could specify the amount of ticks away from the current best bid. So he would place blocks of orders, usually 4, 5, and 6 price points away from the current best bid, and they would sit there, and there would be very large orders, like 600 lots on each price point. And then the functionality that he sort of designed and got someone else to create for him was such that every time the price moved higher or lower, this sort of block of sell orders would move in lockstep. So they would never get any closer to the current price and would therefore never be hit. And what that did, in a quite a rudimentary way, is just add huge amounts of selling pressure, to the market. And if you imagine that algorithms are looking and suddenly seeing that the amount of sell orders at those price levels is significantly higher than the amount of buyers or whatever, then they'll react to that. And then simultaneously to doing that, he would also be just shorting the market, waiting for it to go down a couple of ticks and then exiting his position. So it was almost like I sort of used the analogy of a sort of turbine in the book, but a lot of people are sort of surprised that he could have such an impact, but he would do it for short periods of time. Like he would do it in a burst of 5 minutes or 10 minutes when the market was already falling, and it would just add to the downward pressure in the market. And he would be in and out so quickly that he wasn't sort of relying on the market to fall several percent or anything. He would just get in and out after a few ticks, but he was trading such big size at that point, hundreds of lots, going up over time. It went up, but so that, that's still a very, very profitable strategy.
There was also something about this software. There was all the functionality of it is actually covered in the book. But there was one part where if there was another order added to the queue, his order would increase by one lot so that it would send him to the back of the queue. What was his intentions in doing something like that? Because normally the fight is to get to the front of the queue, but he was intentionally moving his orders to the back of the queue and wanted to be last in queue. Was that, again, just part of his intent to spoof the market?
It was, yeah. So basically, over time, the kind of original algorithm that he built becomes slightly less effective as other market participants become more sophisticated and as HFT, really kind of starts dominating the market. Other participants suss out fairly quickly that if there's this sort of price, if there's a load of sell orders that are like miles away from the current price, they're not going to take that as much into consideration. So Nav realized that in order to really sort of trick other market participants, he needed to place orders right near the current price. So what he then started doing is he invented this thing that he called back of the book, whereby he would place a bunch of orders, usually at one or two prices above the best bid. And what would happen, as you rightly point out, is every time a new order arrived behind his orders, his algo would automatically increase his order by one lot. And because of the CME's system, what that would do is just send his orders automatically to the back of the queue. And because it's such a busy marketplace, by putting that on, that meant that those big orders that were having downward pressure on the market were constantly being sent to the back of the queue and never, ever being hit. And so, again, what he would do is at the same time as doing that, he would enter a genuine short position, wait for the market to sort of tick down a couple of ticks and then get out again and switch the algos off. I was lucky enough to speak to some of the investigators that investigated his case. And they said that basically Nav was kind of amazing because he had so many strategies, so many nefarious strategies. So he would do this thing where he would place all these big orders away from the market. He would do this other thing with the back of the book so they were closer to the price point. And he would also do like manual spoofs. So he would flash 2,000 orders just for a second or two. And it was all just designed really to trick the automated algorithmic traders into supply and demand in the market for long enough that the market moved and he could make a small profit.
Right.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform, and using active trader mode 30 days. Visit Tasty Trade Incorporated as a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sides from penny stocks to big caps, savings? It's a game on live data, master the platform, start trading with Trade the...
To really spoof the market. Did they say anything about how effective it actually is?
I mean, there's different points of view on that, and I would say that it becomes less effective over time, but, it was sufficient for Nav to make a huge amount of money as a sort of bedroom trader. And if you look at, if you look at recent news out of the US Department of Justice, they've fined and gone after traders from the biggest HFT shops like Tower Research and Jump. They've got this big case at the moment where all these JP Morgan metals traders are being criminally charged for running sort of spoofing schemes for a long time. You're talking sort of dozens and dozens of traders now that have been criminally charged with spoofing. So I would say that it works. It's hard though. At the end of the day, you've got to have the capital that if you get it wrong, you've got to take that bath. And Nav did everything he could to sort of mitigate that.
Yeah. And Nav did receive, before the flash crash occurred, Nav actually received some letters or some warnings, is maybe a better word, from the exchange or regulators. Like his activity had sort of showing up on their radar somehow.
Yeah, so one of the things about Nav's story, which engenders a lot of sympathy with him, is that he felt like not only did he complain on the forum about what was going on in the market and what he was seeing, but he complained to the CME all the time. And to the point where he was like a total pain in their ass. Like he would phone them up and he would threaten them, and he was just so pissed off because he saw spoofing all the time. But because the CME didn't do anything about it, they didn't take him seriously, he just took the view in the end, well, fuck it, I'm going to do exactly the same thing. And he did. And you're right, like they did send a couple of warnings. And then much later in the story, after he's sort of been identified, then, yeah, they did. The CFTC, the actual regulator did start to write to him as well. But it was pretty sparse, to be honest. And I feel a lot of sympathy for Nav, because if the CME was doing its job, they would have noticed what he was doing pretty quickly, told him to cut it out. They could have given him a fine or whatever, but they didn't do any of that. And so, he ends up going from nothing to criminally charged.
Yeah.
Because there was just no oversight at that point in time.
Let's jump forward a little bit and speak about the actual flash crash event. So this is the flash crash which occurred in 2010. Let me just ask you this question straight out. Can he be blamed for causing the flash crash?
Almost definitely not. One of the things that I tried to do as a journalist is not overstretch my kind of capabilities and try and sort of get into the data and kind of economic analysis of this, because that's not my field. But what I did do is talk to as many people as I could from all different perspectives, including lots of finance professors, including the people that actually investigated the flash crash. And, there's a very wide dispersal of views. One thing I would say is that at the time in 2010, there was already an investigation into the flash crash. And what they found is that this big US pension fund had placed a massive, non-price sensitive sell order into the market in an already extremely volatile day. And that was exactly at the point at which the market began to fall. So there was already a sort of major trigger. And if you look at the macro conditions that day, it was right in the heart of the Eurozone crisis. There was like Greece was, had suddenly received a bailout. And so there were all these swirling conditions that made the markets extremely volatile. And I think the most you can really say about Nav is that he was a big participant in that marketplace. He did place a huge amount of spoof orders that day. But no one's been able to sort of definitively prove that he was a major contributory factor. I think in the book I use this sort of analogy of like, how do you turn around and say what caused the First World War or something? Like you could read thousands of history books and they'll all come up with different factors depending on how they sort of view the world. And I think the Nav was undoubtedly a factor in the same way that anyone that was trading significant size is a factor in a market at any point in time. But nobody successfully sort of demonstrated that without him, there wouldn't have been a flash crash. And for what it's worth, I strongly believe the flash crash would have happened anyway.
Yeah. I mean, markets are such complex systems and there's just so many factors to be able to pinpoint a single cause. I just don't know how you could.
Well, yeah, the only thing I'd say on that, to give them, to be fair to the US authorities, they were always quite careful to say he only helped cause or he contributed or something.
Okay.
But inevitably, if you put that in your press release, then he becomes known as the flash crash trader. And, I think that they tried to almost use the flash crash to get more publicity for this case. And they probably didn't need to do that. They should have just charged him with spoofing and included the fact that he was spoofing on the day of the flash crash, rather than sort of pinning the flash crash on him, as you say, which, was very, very hard for them to be able to actually stand up.
Yeah, that makes sense. That large fund, and you speak about this at length in the book, which was selling like billions of dollars worth of E-mini futures that day. And they were using some sort of algorithm to do so, like almost like a volume participation algo. Would match the volume which was being done up until they'd sold the quantity that they needed to get sold. How did they escape the hot seat through all this?
Well, because there's no criminality for being stupid. Ultimately, it was a really, really dumb trade. As you say, it was entirely volume sensitive, and they didn't put a price floor. They basically just put this order through of like, we want to sell 75,000, I think, off the top of my head, e-minis. And they were going to sell them at a rate of 9% of the volume in the market at that point in time. But obviously volume went absolutely through the roof because it was this sort of market crash. So they were just like selling into a falling market. And there seemed to be no real traders there that pulled the plug and said, hang on a minute, let's cut this order. So they did, they got some criticism for it, and they obviously lost some money. But yeah, they didn't, other than sort of maybe a bit of embarrassment, they certainly didn't face any sort of criminal charges or anything.
Yeah. Before we get into the criminal charges, etc., which Nav found himself up against, this is something I was totally unaware of before reading the book, is Nav actually had interests or investments in various businesses. I don't expect you to talk about all of them, but could you just tell us about one of those businesses which he had invested in? Like, what did he do with his trading profits?
Yeah, so one of the most intriguing elements of this whole story is that Nav never told his friends or family how much money he was making. He's quite a humble, kind of eccentric guy, and he took the view that if other people knew about it, they would treat him differently. So he basically just kept it to himself. And at some point, his accountant notices that he's making millions and millions of dollars and says, hey, Nav, you should meet some of my friends. They can help you invest your money. And so he gets introduced to, it's no exaggeration to say, like a queue of salivating criminals who basically see him coming. There's this guy who's making vast amounts of money, but has got no use for it. And if you tell him, Nav, we can get you a fantastic interest rate, then he's sort of willing to do it. Because on the one hand, he's incredibly gifted at trading, but on the other, he's quite a sort of naive individual. He's not very worldly. And so there's a whole litany of these characters, but one of the main ones is this sort of Mexican entrepreneur called Jesus, who kind of comes into the picture, and he's got this scheme, and he offers Nav and other participants 11% guaranteed returns per year. And if you can imagine at that point, I think the interest rates, UK sort of base rate was 0.5% or whatever. So it's pretty hard to guarantee someone 11% returns. But this is what this guy did. He's just this kind of amusing character who's got a kind of Russian wife called Ekaterina. He lives in Zurich. He drives a BMW electric car, and he's got a chauffeur-driven town car, and he looks the part. And Nav ultimately, without sort of giving the end away, but ends up giving almost everything he ever makes to this guy and people like him.
How was this guy guaranteeing an interest rate of 11%? What was he doing with the money?
That particular investment was around something called trade finance. So basically, and it might be, this is sort of from memory, but essentially, say you've got a situation where, a country wants to buy a huge amount of coal, and you've got a coal producer, but to actually get the coal to the country and for them to sort of verify that it's the right amount and to actually make the payment is a process that can take several months. So you get these companies that sort of sit in the middle, get things called letters of credit or letters of guarantee from both sides to confirm that subject to these conditions, they will do the deal. And then they kind of step in and put their money in as like a stopgap. And then they'll take a sort of cut of the profits. And so this guy, Jesus Alejandro Garcia, basically told Nav that he was this kind of Mexican wealthy magnate from a family of very successful Mexican businessmen, and he knew governments and companies around the world, and therefore he could make these connections. And so the idea was that all this money would be used to kind of facilitate what they called the global trade of physical commodities. So that was the pitch. But, you and I know that there's no such thing as risk-free returns. And if there is, then why the hell are you opening up that opportunity to other people,
And how much money did Nav put with him?
So by the end, he put with him £45 million. So something like $65 million, at least at the point where I write about it in the book. And yeah, I mean, it's a sort of a bit of a tragic element to the whole story, really. But basically what happens is that investors like Nav kept getting their interest. And so he had a huge amount of money. And before that, because interest rates were so low, he was getting hardly any returns on his money. And suddenly this guy comes along and, Nav puts in a smaller amount, then a bigger amount, and he keeps getting these returns. So each quarter he's getting like interest of, a couple of $100,000. So he starts to trust the guy, and he gets paid reliably for 3 years. And, not to give too much away, but Nav, once he gets arrested, has to come up with bail. And the bail is set at £5 million based on how much he's made over time. And so £5 million shouldn't be too much of a problem for Nav, but he finds quite quickly that he can't get the money.
It's tied up.
Yeah, so not only has he just been arrested, but it's only at that point that he starts to realize maybe all of the money that he's been saving all this time isn't as safe as he thought it was.
Yeah. So what led authorities to identify Nav of wrongdoing? Like, why was he ultimately arrested?
Well, yeah, so that's another interesting side to this whole thing. So it wasn't that the regulators or even the exchange noticed what he was doing, even though he was at points placing orders of like the 2,000 lot maximum and then pulling them. Nobody noticed. The only reason he got caught, and I think I will leave this for people to read it because it's a really interesting sort of side story, but there's another guy who, like a lot of your listeners, is a day trader, and he was using a kind of sort of combination of point and click trading and algorithms, and he was developing his algos, and he was back testing his recent kind of upgrades to his trading system, and he decided randomly to do it on May 6, 2010. And then when he did that, he noticed that there was all these huge blocks of oversized sell orders that were appearing and then disappearing, 4 or 5 ticks away from the market throughout that whole day. And then at this point in time, the US had just enacted the whistleblower program. So you could get paid to blow the whistle between 10 and 30% of whatever the CFTC or the DOJ end up getting. If they prosecute someone, you can get as a whistleblower. So he saw an opportunity. And so that's how, and so, from there, the investigation starts. So, it was another day trader that shopped him, basically.
Obviously, there's a lot more around that. I'm interested, though, just to ask you, and I'm not sure if you have the answer for this, but how much influence did the larger HFT firms have in pushing forward this case also? Like, once it began to get a little bit momentum, did they become more involved in this? Because obviously what Nav was doing in the market was upsetting their systems, I presume.
Yeah, it's a really interesting point. So there's a lot of people that believe that spoofing is a kind of reasonable reaction to the growth of high frequency trading. And I kind of write about it in the book. But if you imagine HFTs are essentially just monitoring the order book, looking for signals that the market's temporarily going to fall or rise, and then essentially using very fast technology to try and get to the front and capitalize on that trade. What Nav was doing is saying, well, if all they're doing is essentially front running, I'm going to fuck with the signals and confuse the algorithms. And that's what he did. And so you're absolutely right. The HFT firms, particularly Citadel, ended up being like the regulators' eyes and ears in the market, and they're the sort of regulators' best friends, because people like Nav, and there's another guy called Igor Oystacher, this kind of Russian huge day trader, also active in the E-mini, and basically the likes of Citadel end up being witnesses in the prosecution of individuals like Nav, because they were the ones that were getting hit. So there's a sort of slight irony there that these firms that are billion-dollar firms that a lot of people think are very controversial anyway, and that are the subject of books like Michael Lewis's Flash Boys, because a lot of people think, well, you know, what value are they adding to the market, are the ones that end up benefiting when guys like Nav get taken down.
So what was Nav actually charged for? Like there was something like 22 different charges, I think.
Yeah, so Nav was kind of unlucky in the sense that he was only the second individual ever to be charged with spoofing, because spoofing was a brand new law that was brought in, or anti-spoofing law was brought in with Dodd-Frank. And so at the time, they needed to charge him with as much as possible because they didn't know what was going to stick. So they charged him with wire fraud, and they charged him with market manipulation and with spoofing. And they've all got sort of different requirements to prove. But spoofing is quite a sort of blanket thing, which is like you're not supposed to place any orders that you intend to cancel. And at that point, it was completely unproven. And there was a lot of people that were saying, well, that's ridiculous because if you place a stop loss, for example, or an iceberg, all of these things, you know, you hope or intend to cancel them. So
throughout his case, was there any consideration given to the fact that he was also an incredibly talented trader? Like here we've spoken about, you know, he was in trouble for spoofing, etc.
Yes.
Like sure, that probably helped to some extent. But I think there's also no denying that he was just a brilliant trader.
Well, you know, I am a fanboy of Nav, really. Like, by the end of the book, I was just totally and utterly on board. Not to say that what he did, you know, he shouldn't have got caught for, but ultimately he was just an incredibly gifted and talented trader. And it, you know, I'm sure I don't need to tell you, but it's so hard as a day trader away from like a trading desk at a major institution to consistently make money. And Nav just did it from the word go. And even when he decided to sort of go over to the dark side and build this spoofing algorithm, it was kind of genius. Like the way that I see it was like he kind of saw a flaw in what the algos were doing, and he off his own back with no sort of prior training designed his own algorithm to fight back against them. And it worked incredibly well. So, you know, I hope that readers of the book will come away with that sense of like, even though what he did was ultimately illegal by the letter of the law, he was a fucking great trader and a really unique talent in the markets.
Yeah. And was his broker ever scrutinized for, you know, a lack of oversight, I guess?
Well, I think they got away with it a bit because his broker was MF Global. And in 2011, MF Global, I think it was 2011, was declared bankrupt. His sort of most egregious or biggest trading periods of time was with MF Global. But it's definitely true that his brokers were pretty slack and even sort of knew what he was doing. Anecdotally, it seems like. But basically just were like, this guy is just absolutely creaming commissions for them. So
of course,
they just sort of shut up and let him get on with it. I think there's been a couple of examples now in the US where brokers have actually been charged alongside traders. And the other sort of corollary point on that is that Nav, even though he came up with the designs for these algorithms, wasn't a computer programmer. So he had to hire developers to build the machines for him. And again, it sort of raises similar questions. Like if you build an algorithm that's so obviously going to be used to to spoof the market or do any kind of manipulation, to what extent are you aiding and abetting that? Are you part and parcel of that, or is that just the responsibility of the trader? And that's a question that comes up in the book as well.
Yeah. So Nav was arrested. He was extradited to the US and went on trial over there. What was the outcome?
So he was arrested over here in 2015. He was extradited to the US, and at that point, I think it was pretty obvious that the evidence against him was pretty strong. And I know a lot of people are very sympathetic for Nav and think that he's a scapegoat and what have you. And I am definitely sympathetic with that view myself. But what they need to realize is that Nav had communicated with various programmers in such an explicit way. So he'd put in various emails, I want my spoofs to work better, or I keep getting hit in my orders, my spoofs aren't working. So as a case, he was kind of screwed, really, because the evidence of intent was so strong. So he pleaded guilty in 2016. But what happens then is pretty remarkable, is that his lawyer struck a deal with the US Justice Department that he would assist them with their understanding of the markets and with other ongoing cases. And depending on how much of a good job he did, they would take that into consideration when he was sentenced. So you have this amazing section in the book where Nav basically sits down with various kind of members of the FBI and US prosecutors and basically explains to them how HFT works, what spoofing looks like, what the order book is. And they're kind of sitting there like completely clueless. And they get this schooling from Nav, and that ends up forming the sort of bedrock of their understanding of this type of trading. And so since then, it's no exaggeration to say off the back of that, all of these prosecutions in the US have been helped by Nav's intelligence that he provided them. So anyway, in answer to your question, only very recently, earlier this year, he went back to Chicago and was sentenced, but he ended up only getting a year of house arrest. So at one point, he was staring down the barrel of like decades in jail, but because he was so helpful to them, and not only that, because he was also quite a vulnerable character, he was diagnosed with Asperger's, he still lives at home with his parents, he hasn't got any money, so they kind of took they took some sympathy. They felt sorry for him in that respect, and he was so helpful to them that they just gave him a year of house arrest, which is kind of ironic that we're now sitting here under house arrest ourselves. Nav's timing as ever was impeccable.
Yeah. Well, thankfully he didn't go to jail, because I think that's way too extreme for something like this. And as I said earlier, there's so much more to the story than what we've covered here. There's much, much more. Let's leave it at that, Liam. Anyone who's listening to this and is interested in reading the book, you can find it at chatwithtraders.com/Liam. LIAM. That'll take you directly to Flash Crash on Amazon. Liam, you're also on Twitter if someone wants to follow you. What's your handle?
It's Liam Vaughan, BBG.
Okay, very good. All right, Liam, we'll leave it there. I know there was so much more we could have spoken about, but I want to leave some surprise for readers of the book. So I appreciate you making the time, and I also want to thank you greatly for going to all the trouble to make this and put it all together.
Awesome. Thank you, Aaron. Appreciate it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers open limit lists, ready to sing applicable regulatory registered broker-dealer.
And welcome, ladies and gents. This is episode 195, and I'm joined by Ilan Israel-Stam. Ilan's a co-founder of Australian ETF manager BetaShares and a principal at VC firm Apex Capital Partners. BetaShares first began trading in 2010, and currently it manages approximately $10 billion in assets across 61 funds, all of which trade on the Australian Securities Exchange, or ASX. My idea of asking Ilan to be on the podcast was really just to learn a bit more about how ETF managers operate and to delve into some of the technical aspects of ETFs too. So this isn't supposed to be like an intro to ETFs type of episode. Hopefully you'll gain some deeper insight. Included in the topics we chat about are risks for ETF managers, how ETF managers make money, the important role of designated market makers, how short and leveraged ETFs trade as intended, tips for investing in ETFs, and researchable ideas for trading in ETFs. Now, I have to say it was kind of funny listening back to this interview because we referenced BetaShares Oil ETF several times. And as we recorded this April 15th, it was before crude oil futures went negative. So following this pretty significant event, BetaShares Oil ETF actually took on a similar path to USO. USO being the largest ETF in the US with oil exposure that most of you are probably familiar with. And it took on a similar path in the sense that BetaShares also changed its underlying strategy. It went from holding the front contract to holding contracts further out the curve in order to lessen the risk of the fund blowing up. So, in hindsight, perhaps an oil ETF was not the best example to use, but nevertheless. If you are interested to know a bit more about this, I've included an article link in the show notes. Plus, Ilan also shared with me several articles that expand on a whole bunch of the topics that we cover on this episode too, all of which can be found in the show notes at chatwithtraders.com/195. And that is all, folks. Here is Ilan Israel-Stam for episode 195. I saw an article pop up in my Twitter feed today that BetaShares, the bear ETF that you offer, had the highest volume. No, what was it? The highest, the most popular traded ETF during March.
That's right. Yeah, that's right.
It's pretty. I don't know. I was going to say that's pretty cool, but depends how you look at it.
No, I'd say it's quite cool. It actually traded more than Telstra did.
Really?
Yeah.
That's crazy.
Incredible, huh? Incredible.
What were the numbers around it?
It's about $2 billion traded for the month of March. So on some days it was trading more than Telstra, regularly. So yeah.
That's wild.
Big numbers, isn't it?
Before BetaShares, if I understand correctly, you founded or you were co-founder in BetaShares around 2010. What were you doing before this?
Yeah, so before I got involved in starting BetaShares, I was actually in management consulting. So I was working for a company called the Boston Consulting Group, or BCG. It's a large strategy consulting firm that typically does work for CEO level people in organizations, usually quite large organizations, helping them think through big strategic problems such as, should we enter this country? How do we properly go about launching this particular product? And I was spending a lot of my time in the financial services space. But before that, I'd always been entrepreneurial. So I'd always been doing entrepreneurial activities throughout my life, all the way back from being a young kid. And I remember my brother and I set up a little mini golf stand in our backyard for the neighborhood kids to come and play. And we charged them, I think 10 cents or whatever a time. So always had an entrepreneurial component. I spent some time doing other bits and pieces of my own businesses. I went to China actually and spent a whole lot of time there, where I set up a media-oriented business. But then that particular business was built right about the time of the other large crisis. We're busy recording this during the coronavirus crisis, but
that business of mine was built during the other large crisis, the global financial crisis, or GFC. And so just at the time when I was about to essentially close the deal on a very large amount of financing or equity financing, the global financial crisis hit, and that got pulled from under me, which was not so fun. But that experience was pretty instructive and helped me to think about all sorts of entrepreneurial activities. And so when I came back to Australia after BCG and after the Chinese experience, I connected up with a few friends that I'd known from university, and we started working together. And that was the genesis of Beta Shares. And I also still maintain an involvement in an investment company called Apex Capital Partners, which is essentially a venture capital style company that provides funding to early stage companies in and around the financial services space as well. So yeah, financial services has always been my main activity. And so with those two activities, Beta Shares was born actually out of the global financial crisis in many ways, where things were changing a lot in the industry, the wealth management industry, and we saw the opportunity in what is known as exchange traded funds, which I'm sure we'll talk more about. And exchange traded funds were growing very fast over in the US, but in Australia, when we were looking at starting Beta Shares, it was a very small, very tiny little market. I think it had about $5 billion in total, and we decided that there was an opportunity to build out an Australian-focused specialist exchange traded funds business, really tailored to the needs of Australian investors and focused on those needs. Our competitors are very large global financial institutions who are incredible businesses, but don't necessarily focus only on Australia and the needs of Aussie investors. So we thought there was an opportunity. We really liked the space, the ETF space. It was a very fast-growing industry for a number of reasons. The writing was on the wall for that to continue, and we thought we had the chops to be able to build out a business. And yeah, since then it's been a good, really great growth pathway over the last about 9 years. So we started our first fund at the very end of 2010. So it's about nine and a half years now since we started Beta Shares.
Yeah, I think you did well to foresee that the rise of popularity in ETFs would come to fruition. It seems like such a big thing to take on. Like, where do you even begin when you decide that you're going to launch an ETF management company?
Well, just like anything, you research the market, you understand what's involved in starting one up. You obviously have to have faith in yourself that you or your partners have got the abilities to actually build out this business, and that's important, because it is quite a technical space. It is one that does require a fair bit of knowledge about the regulatory environment, about things like the way in which funds are bought and sold, and the way in which you get your funds exposed to investors of all sorts, whether they be end investors or advisor investors, etc. So my partners and I had some background in financial services. It wasn't the first time we'd been looking at the space, so that helped a lot. And then when you think about actually setting up the business, you think about what sort of business you want to be, what is your sustainable competitive advantage. And as I said, for us, we thought that one of our big competitive advantages was that we were going to be specialists and we were going to only focus on the small country of Australia, because for the other players in our space, it's a very small part of their whole map. If you think about them looking at their global portfolio, Australia is going to be a tiny part of it. But for us, we knew the space was big. The superannuation industry was large. The self-managed superannuation industry was growing. Financial advisors are a big part of the space here as well. And so we looked at all those things and thought that this is all coming together very nicely for what looks to be something that will be a good business. And then, it's all about thinking about the products themselves. So, which products should we launch? But we were lucky because when we launched the business, there really weren't too many options out there for ETFs. There was probably 20 or so. Now there's over 200. So we had a huge amount of space to fill. And we ended up doing quite well by building out a pretty big range of funds. And we've now got 61, actually. We've got 61 ETFs, and we're managing just over $10 billion now. So that was a great path. And a lot of it came back to the usual thing, thinking about your core competencies, thinking about what your strengths are at a personal level, and thinking about where the market's headed and where it is now, where it might be headed. And all those things were very positive for the ETF industry. And I think that's coming true. So to put numbers to it, when we started Beta Shares, there was, as I mentioned, $5 billion in assets invested in ETFs in Australia. is now about 60 billion. So, and we've been lucky to be taking a good share of that growth every year since we've been in the market.
And those 61 ETFs which you've issued, they are all trading on the ASX?
That's right. Yeah. So all of our funds are bought and sold like a share on the ASX. And so that's what an ETF is. An ETF is a managed fund that can be bought and sold like an ETF. The ETF stands for Exchange Traded Fund. So it can be bought and sold like a share. That means that you don't have to fill out any paperwork as you would any traditional managed fund. There's no minimum investment levied by us, and so you can buy and sell it at any time during the trading day. And ETFs, now that we're onto the topic, are typically index tracking funds. Not always, but they're typically index tracking funds. So they typically aim to track an index, and those indices can be of many, many shapes and sizes. But a simple example, you want to get exposure to the technology sector, and most people would have heard of the NASDAQ 100. NASDAQ 100 is the largest 100 companies that are traded on the NASDAQ stock exchange in the US. And they involve all the large global technology stocks. So Google, it's now called Alphabet, but Google, Microsoft, Netflix, Amazon, Apple. So instead of going ahead and buying those individual securities, you could buy an index tracking fund, and that's what an ETF is. So we have got the NASDAQ 100 ETF, for example, the NDQ. So you buy and sell it using the ASX code NDQ, and that gives you exposure to those technology stocks. So it allows you to get exposure to what you want as simply as buying a share, but not necessarily only getting a single share's exposure. And typically, because they are index tracking funds, they're much lower cost than traditional managed funds that you would have heard about that are managed by these star investment pickers who pick stocks, etc. We typically just try to manage to an index.
Right. So I obviously have a lot of questions around this, a lot of maybe technical questions around your role as, now let me just get this correct before we proceed too much further. Calling you an ETF manager, is that the right term? Like what is beta shares exactly? Like what's the right terminology?
Yeah, that's right. So we are a fund manager that specializes in exchange traded funds or ETFs. That's the exact terminology.
Okay, cool. So let's get started on this. Let's get down into the nitty gritty. One of the first things I wanted to bring up with you around this is talking a little bit about risk. So your role as an ETF manager, and I guess you can sort of partially speak for any ETF manager really, what risks are you vulnerable to in the position of a manager?
Yeah, so to clarify again, we are the fund manager of the exchange traded funds. We manage 61 of them at the moment. They are of all shapes and sizes. So they're not only share oriented or equities oriented ETFs. We've got bond ETFs. We've got cash ETFs. We've got ETFs that aim to provide you exposure to the gold price. We've got ETFs to provide exposure to the crude oil futures price. We've got funds that are aimed to actually go up when the market comes down, which are the short funds that we have. So that's our role. Our role is to allow investors. We essentially are creating investment tools for investors to basically back their view or take a view on whatever it is that we're providing that exposure to. So what we don't aim to do, unlike perhaps other fund managers who have come on your show or fund managers that your listeners would be familiar with, we don't try to outperform a particular index like the ASX 200 necessarily. We as the ETF provider are the ones that are putting together these investment products for you to use for your own portfolios. So in terms of risks, to be honest, there's no specific extra risks that we would be exposed to as an ETF manager above and beyond the risk of any other fund manager. And for that matter, as an investor in an ETF, there's also no extra risk that you take on investing in an ETF beyond the risk you take on investing in the ETF itself or fund itself. So for us, what makes our business tick is the funds under management. So we get paid often a very modest fee for every dollar that we have under management. That's what makes our business tick. So risk-wise for us, frankly, not a huge amount. It's all about, for the investors, the movement in the underlying investments, which will cause the risks. So, of course, if you choose to invest in products that are very volatile, where the underlying index is very volatile, or for example, take for example the current market. We're recording this in the middle of April 2020. The current market, the crude oil world is going nuts. Oil prices was below $20 at one point. So that's a highly volatile. So therefore, you're going to have risk on that particular investment, but simply that's the investment choice you have made. Or for example, if you use some of the geared funds we have, you get much more risk associated with being in a geared position. But no, there's no additional risk as such that we are responsible for or that we are vulnerable to. And so, no, I think that would be the way I'd answer that question. You don't need to look at us any differently from any other fund manager you may have spoken to.
So I might just rephrase that question a little bit. I guess it's a slightly different question, actually. But as the manager, to what extent are you concerned about the ETF price? Let's just pick on the oil example, which you spoke about. So obviously, as a trader or investor, someone who buys, goes long that ETF, which has exposure to oil, if that goes down in price, then obviously that's not ideal. But as a manager, someone like yourself, if the price of that ETF or the price of oil decreases further, what sort of position does that put you in? Are you at an advantage or disadvantage either way?
We're not really at an advantage or disadvantage either way. Ultimately, we need to make sure that our funds are providing you as an investor with the objective that we have set out. So in the case of the crude oil futures product, it gives you exposure to the price of crude oil futures. If the price of the crude oil futures goes down, then it should be expected by the investor, and we expect that the unit price or the ETF price will go down. So the only reason why we would mind as such is because it means that if the asset value goes down, then so too does our assets under management. But again, that's just the nature of being in the market. We can't control that. So all we can control is making sure that the investor gets what they are after. And if they have chosen to invest in oil and the price of oil has fallen, then obviously they should not be upset to know that the ETF price would fall. That's what they've signed up for. And we need to make sure that we're providing that exposure. And then on the other hand, we just need to make sure that these products do what they say on the tin. And that's what we really spend our time thinking about. So we can't control that. We can control the fact that we want people to invest in our funds. And so, of course, we're out there educating the market, and whether that be financial advisors or end investors about ETFs. And clearly we want to get people to invest in ETFs as an industry. But we do that because we think that it is really, for most investors, a very sound way to get started in the investment industry. And indeed, even if you're not a beginner, to trade your view of a particular exposure.
Okay. So have you felt any adverse impacts from this recent market downturn?
Actually, we have not had any adverse impacts. We are very diversified as a business. As mentioned before, we've got 61 funds. And importantly, it's, as I said before, those funds do not only cover shares. So they do not only cover shares. As a result of that, we've got bonds, we've got cash. So what generally that means is that just like having a very diversified portfolio, almost independently of the market conditions, there will be something that does well and there'll be something that does less well. Our business is like a microcosm of that. So as a result of that, we have, of course, seen pretty significant falls in the value of our share-oriented funds. But at the same time, we've had other products, such as the ones that go up when the market goes down, that have risen tremendously in value. So we are ultimately in a pretty similar position that we were before this all started. And most importantly of all, our funds have been able to do what they said they were going to do. And that's really what we care most about. They've been able to give people those exposures. Whether those exposures are positive or negative, they have done what they were sort of produced to do in the first place.
Yeah. So because the big thing for you is the amount of the assets under management, you've probably seen some money shifting out of some products, but because you have so many to offer, that money flows into other products instead of just being pulled out altogether.
That's exactly right. And in particular, given the current market environment, I will repeat, we're in the middle of March 2020, depending on when somebody comes to listen to this, things were, we're in lockdown mode at the moment. And so hopefully by the time somebody comes back to this and listens to it in a few months' time, we won't be. But in particular, we have seen people selling out of fixed income and buying into equities. People seem to be thinking, in particular with Australian equities, actually, we've been seeing our Australian equities funds being bought fairly heavily and our fixed income funds being sold down.
Okay, interesting. Now, just to pick up on that point of assets under management being a big thing for your business, can you just explain that a little more? Like, why is that key to your source of revenue?
Well, the way in which an ETF manager earns a living is to take a fee for funds under management. So essentially what happens is there's a fee that ranges dramatically depending on what the particular ETF is, where every day out of the unit price, there will be a tiny amount that comes out in the form of a fee. So that is a way in which an ETF manager exists. That is essentially the reason for that is the way in which the revenue line of an ETF manager actually operates. So that is why. So if there is more funds under management, then each of those, obviously there'll be more fees to collect. If there's less, there'll be less fees to collect. So that's the reason.
Now, how does a trader or an investor actually see those fees?
Well, that's the good thing. They don't. It just comes out. If let's say the fee was 10, we call it basis points, to 0.10% for the year, that means that every day, 10 divided by 365, 10 basis points divided by 365 being the number of days would come out of that unit price. So it's pretty much undiscernible to an investor. They don't actually have to pay it. It just comes out of the unit price every day.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one speed and on your stock /double. Offer expires with Trade the Pool's limited, short, any shares within minutes. No subject before you ever pay.
Questions around the holdings. So actually understanding how you manage the underlying assets or underlying securities of the ETFs that you provide. So as a manager, how do you decide when to add or remove securities from an ETF? And maybe it might be helpful for these lines of questions if we pick an example. So if we maybe focus on your oil or your gold ETF, I presume with your oil or even your gold ETF, it might own like sort of 50 different gold companies, publicly traded gold companies, as well as maybe some exposure to the actual commodities. Is that right?
So it's not quite right. So essentially, again, with 61 different funds, we have a whole range. So we have a gold bullion fund, and literally that owns gold bullion. It actually owns physical hard gold in a vault in London. So obviously in that case, there's no decisions about taking out any securities. It's just gold. That's all we're doing. We're providing you with exposure to gold. That's called QAU, that one. You get exposure to the price of gold. That one has a currency hedge over it, so you don't have to worry about the price of US dollars versus the Australian dollar. So that one, it couldn't be more simple in a way. We just basically buy as much gold as people have invested in the fund. We, on the other hand, to continue with the theme on gold, we do have a gold miners ETF, and that's MNRS, as it turns out. That's the name of the ASX code for that one. So that one does own the world's largest gold miners companies, gold mining companies. So it's an ex-Australia fund. So it doesn't include Australian gold miners. It includes gold miners excluding Australia. And now this will give us an answer to your question. So as I mentioned before, the vast majority of ETFs track an index. So when we talk about the gold miners ETF and what we are buying there, we are buying the underlying gold mining companies that are part of an index. And in that case, it's an index that's created by a provider. That particular index is created by a provider. NASDAQ. NASDAQ's got an index business, and they've got a series of indices that track gold mining companies. And so we actually, again, do not make the decision as to which particular gold miners to buy. We track that index in its entirety. So what that means is that these indices often do what's known as a rebalance. So that could be an annual or quarterly or semi-annual rebalance. And that is the time in which we, given that we are trying to track that index, we will buy and sell those particular securities to be in line with the underlying index. So maybe to a much simpler example, an example that people will understand, the ASX 200. The ASX 200, we've got a fund that has exposure to the largest 200 companies on the ASX. It's called A200. So what do? We basically will buy all those 200 companies that are part of the ASX 200 index. That ASX 200 index will rebalance itself regularly. I believe it might be quarterly in that particular case. What will happen is that companies that are no longer part of the largest 200 companies will move out of the index. Companies that have grown and have become part of the 200 index will enter the index. And we essentially will make those same trades on that day of the rebalancing. So that is the way in which we decide, and we don't actually decide. I guess the point is there isn't any discretion what goes into that particular product. So it's more like we are acting on a set of rules set by an index provider, and we are providing that back to you as an investor. So you don't have to rebalance. You don't have to go through the list of the top 200 and decide what is right and what is wrong. We will essentially do that for you, and we will take care of all that trading.
Okay, so just so I understand correctly, across the 61 products that you offer, there's no real decision making from your part as to what the underlying securities are.
That's right. The decision making on our part on the passive funds, and I'll come back to one quick issue on that. On the passive funds, the decision that we make is which product to launch, and then which index we should be tracking. And at times, we will even help create that index. But once those index rules have been created and it's published by a third party, our role in those passive funds is to provide access to those particular companies. Now, in saying that, we do have a range of active ETFs by which there is somebody making a decision about what to buy and what to sell. But we do not, as it turns out, we do not make those decisions ourselves. In those cases, we have partnered with a third-party fund manager, and that fund manager will be the one who makes the decisions. And in that case, we are providing investors with an actively managed portfolio where somebody is making those decisions, and we are providing that to them in the ETF form or the ETF wrapper.
Okay, understood. When you do rebalance, let's say the ASX 200 index, the ETF which tracks that, when you rebalance your exposure to the underlying securities at the end of each quarter, how are you executing those trades? Like, are you trading throughout the day, or are you doing most of this in sort of the pre or post-market match?
It'll be at the end of market. It will be the end of day. I will be trading typically at the end of day. And we've got a portfolio management team whose role it is to do that. And they would do it typically at the end of the day.
And how do you determine how much of the underlying securities to hold on your book? So again, let's just stick with this example of the ASX 200 here.
Great.
How do you decide, how many shares of BHP you need to hold, how many shares of Rio, Westpac, etc.?
Yeah, okay. So that is a result of what is known as the sort of the index methodology or the index rules. So taking the ASX 200, and it's a simple, nice, I think, good and simple example. The way that particular index is set up is that it is based on the market cap of those 200 stocks. So essentially, it is the largest 200 stocks weighted, we call it weighted by their market cap. So that, the calculation is done to say that, and I'm looking at it yesterday, turns out that CSL, because of how everything's been going in the healthcare space, is the largest company on that ASX 200. And let's say that CSL has a 10% weight. Out of the 200 companies, if you look at their market cap, CSL represents 10% of the weight of those total 200 companies. So we will simply just buy. We know how much we've got invested in our ETF. We will simply make sure that we have 10% of that invested in CSL. And then we'll go down the list. Commonwealth Bank of Australia, 7%, BHP, 6%, et cetera, et cetera. So we will essentially be using the weighting methodology that has been created by the index provider to decide how much to buy. And in this case, it's simply market cap. In other cases, there's a variety of different things you can use to decide those weightings. So you could use an equal weight if you wanted to, or you could use weights based upon the fundamental values of a company, or you could use weights based upon a scoring methodology. And again, with 61 different funds, we've got a variety of different ways in which we do that. But typically, market cap still is the most used weighting methodology.
Okay, so just simple numbers here. Let's say you had $1 million invested in your ASX 200 ETF at the end of the quarter, and the guidelines were 10% to be invested in CSL. So you would buy $100,000 worth of CSL essentially.
Well, it'd be that's right. Okay, that's exactly right. Yep, that's what we would do, and we would make sure that is where it goes at the rebalance date. We would make sure that if CSL had a 10% weight, we had made sure that we had 10%, or in that case, $100,000 of our portfolio in CSL.
Now, during the quarter, obviously, as it's trading each day, the funds under management for that particular ETF is increasing and decreasing.
Yeah.
Are you then required to increase your holdings throughout the quarter, or decrease your holdings throughout the quarter?
Yes, of course. So if the ETF is growing in value, we'll have to obviously buy more shares, but we're still going to be buying them in the proportions the proportions associated with that index weight. So we'll still be following the index weights. We'll just be buying more depending on how much money it is. So we're always buying the same amount prorated across those weights. And of course, the index weights themselves will change day by day because the share prices are changing all the time. So we just make sure we're following that index methodology carefully.
And how often are you, I guess, trading to keep the market cap correct?
Well, every time that our ETF grows in value, and that can happen every day, we will be trading more securities to make sure that we have got the right amount of percentage weight given our prevailing funds under management.
Okay, so would that just be something you do at the end of the day?
It is.
Okay, gotcha.
Typically, yes, it is, yes.
Yeah, okay. And what about creating new units or shares like of the ETF? How does that bit work?
Yeah, great. So we haven't spoken about the fact that ETFs have got two markets. Well, I'm going to just get a little bit technical, but I'll try and keep it as simple as possible. So when you or an investor is looking at their ComSec screen or the interactive brokers or whatever they use to invest, that is known as the secondary market. So you are essentially out there buying and selling units on the so-called secondary market. You're buying and selling those units either from another ETF investor themselves or from a market maker. So market makers are a pretty important part of the ETF ecosystem, and in many ways, they are critical to the running of ETFs, and at the same time, part of their success, because the market maker is an institution, and I think you may have even, if I'm not mistaken, may have spoken to some in the past on your program, is an institution who is there to create liquidity or to create buy and sells and depth in the ETF industry. And they make their money from taking a tiny little clip of every time somebody buys or sells from them. So they don't mind whether they're being bought from or sold from. They just want to make a trade. They're all about volume. And so they, in order to launch an ETF, you have to have a market maker, a dedicated market maker. And typically we have many more than one that is there to be able to be ready to buy and sell from an end investor at any time during the trading day. And so, as I mentioned before, when you are trading as an ETF investor, you are buying or selling either from another fellow ETF investor or a market maker. And that means the reason that's important is that those market makers are there to provide the liquidity to allow you to buy and sell anytime you want during the trading day. And they also are there to ensure that the price that you have is, being bought or sold to is close to the underlying fair value of that ETF. So, to get back to it, that is what we call the secondary market. Now, the primary market is us. We are trading not with end investors, but with a small number of large institutional players These are the big guys that you would have heard of, the Deutsche Bank, the Morgan Stanleys, the Goldman Sachs, etc., who have become what are known as authorized participants, but essentially they are institutional brokers. And they are the ones who will are there to essentially create these units from us. So let me give you an example. If let's take, for example, back to that ASX 200 fund, if there is more demand than they are sitting there when they started the fund, they said to us, we would like to become an authorized participant for you. And as a result of that, we would like to start with, let's say, $10 million of A200 units. And we're going to be on the market buying and selling those units throughout the trading day. Now, if there is more demand than there is supply, or if the demand is increasing, at the end of the day, that particular market maker will say to us, hey, we know that we're going to need more of this. So we need to create more units. We need to create more units. They will essentially say, we need to create more units. Here's the money. We know that we're going to have this demand because we've had a whole lot of investors buying from us. Here's the money. We will take that money. We will go ahead at the end of the day and buy those 200 shares, and then we'll essentially pass on a package of units in A200 back to those market makers so that the next day they can start trading them on the screen again. And so this is what's called an open-ended fund. And the reason why it's really important is because it means that it doesn't matter how many people are buying or selling. That doesn't affect the price of the ETF on any given day. What matters is just the fact that there is a market maker there who is able to, whenever they want, create more units and at the same time redeem units if, for example, supply is more than demand, or if there's a lot of people are selling, not buying. So that is how we essentially grow the ETF. That is how we create new units in the ETF. It's sort of invisible in many ways to the end investor. All they see is that there's more units on issue than there were before that. But from the perspective of the ETF industry, it's a critical part of the proper functioning of the ETFs themselves.
So the number of units which consist of an ETF, is that generally always governed by the market maker?
No, the number of ETF units is really governed by the demand. So when an ETF launches, it may launch with a very small amount of units. It could be as little as $2, $3, $4, $5 million. We get it started. But that next day, that very first day, if there's a whole lot of trading in that ETF, then quite simply that market maker could go ahead and create more units. We take as I mentioned before, we take those funds, we buy the underlying shares, we pass on these units, and then lo and behold, there might be double the number of units that second day. So that's what drives the number of units outstanding is essentially demand for that particular exposure.
I'm glad you brought up the point about the market makers, because that is something I wanted to ask you about. Could you just speak to that relationship a little bit more? Like, let's say you are launching a new product. I presume one of the things which is very important is having the liquidity. Do you contract a market maker to, support this product, or how does that work?
Yeah, that's essentially right. So first of all, I will say that you're right. When we're thinking about building a new product, first of all, we obviously go through a very detailed process to think about whether to launch it in the first place. We take all sorts of information from around the world, what investors are telling us, what our sales team is telling us, what's happening in the unlisted fund space, what's happening overseas. And obviously we need to make sure that we think we can sell it and that there's going to be demand for it. But once that's all done, we actually make liquidity very, very central to our effort, because the whole point of ETFs is that the T in ETF is tradable, right? ETF, exchange traded fund. So there's no point creating a fund if it can't be sort of easily bought and sold by either the end investor or the market maker. So we think very carefully about that. And you are 100% right that the way in which we get one started, an ETF started, once we've designed it, come up with the index, chosen an index, set the fees, etc. Once we've done all that, we absolutely do make sure that there will be at least one, but typically multi-market makers who are signed on as official market makers for those funds. So they do actually sign a market maker agreement so that we know they will be there to offer liquidity. And the only reason they would do that is because they have got a way first of all, they need to sort of think that that particular ETF is going to trade well, and that means they make some money on that. And also, they need to make sure that it's going to be liquid, so that when they're out there selling, sort of offering units to the market or offering prices to the market, they can adequately hedge themselves on the back end. And they can't do that if the actual underlying exposure is very illiquid. So we do have great relationships with these market makers, and we spend a lot of time fostering those relationships. In fact, we would say it's a source of competitive advantage for us. We keep up with them all the time. We have a large number of relationships. We, during the trading day, are making sure they're doing what they say they're doing. And if they're not, we'll give them a nudge to say, hey, listen, looks like you could do a bit better, or you could bring the price in a bit, or you could increase the volume. So that market maker relationship is critical. And you're 100% right that you really can't start an ETF without a market maker relationship to begin with.
And what are some of the things which you might stipulate with a market maker? So they might need to be, the spread can only be so wide, or they must be quoting, 90% of the time, or like, what are some of the things which you specify with a market maker?
Yeah, so there's a list of rules that are designated by the ASX. So those are the basic rules. They stipulate that you have to be on screen X% of the time. You have to keep spreads, which is the difference between the buy and the sell price, to a certain level. I'm sure, being a trading-oriented podcast, you'll be familiar with spreads. So those types of things. But in practice, we actually go a lot further than that, and we ask them in particular what sort of a spread they think they're going to be quoting, and that's incorporated in our discussions with them. So there's usually this minimum threshold, but we always try to bring it in a lot more. And you'll see that across the board, really, in Australia, those market makers are doing a pretty good job. They are providing very, very tight spreads around the NAV, and they are on screen most of the time, if not all the time. And so those are the types of things we think about when talking with and dealing with a market maker.
How do you ensure products such as your short and your leveraged ETFs work as intended? And what I mean by that is, okay, so we've got the ASX 200 ETF. There's also a short version of that. So if someone buys that, it's supposed to track the ASX 200, but inverse. Yeah.
So those funds you're referring to are our short range of funds, and they're the ones that we were talking about before that have been insanely popular in this recent time period. As I said, we saw as you said, one of those funds, which is BBOZ, which is a leveraged short fund over the ASX 200, has had recorded by far the largest amount of trading out of any ETF in Australia in the month of March of 2020. So that was the $2 billion. So first of all, let's just discuss a little bit about those funds, how they actually are made, because I think that will help answer the question.
Sure.
So how they are made, and there is a difference between the ones that are short and the ones that are long. So first and foremostly, let's start with the short funds. I know that there's probably a good number of people that listen to this podcast that have come across those funds. They are the BetaShares Bear suite of funds, the most popular of which is that one you mentioned, the BBOZ and Bear. The difference between them is that Bear is an unleveraged short and BBOZ is a leveraged short product. So that's the difference. So those funds aim to provide a negatively correlated exposure to the ASX 200. So they don't aim to be directly inverse, and I'll explain why. They aim to be on a given day. They aim to be inverse to a particular range. So the Bear fund on any given day looks to provide a short exposure that is between negative, or basically 90 to 110%. So negative 0.9 to 1.1 of the ASX 200. Whereas the leveraged short fund, the BBOZ fund, is a leveraged fund, as I said, and that aims to be leveraged short to a range of negative 200 to negative 275%, so 2.75 and 2. So that's their purpose. So people shouldn't expect them to be one for one over long periods of time. It's a sort of a daily objective. Now, how they work is actually relatively simple for those who understand what futures are. We are essentially shorting the futures that are associated with a particular exposure. So with the Australian Bear funds, BBOZ and Bear, we are shorting ASX 200 futures. For the BBUS fund, which as it sounds is a US exposure, we're shorting the S&P 500 futures. And in relation to the gearing, the way in which we deal with that, that's just a question of our position sizing. So we're just making sure that on any given day, that particular exposure is in line with that gearing ratio. So that's how they're made. And look, for those funds, they do what they say that they're going to do because it's a very straightforward thing for us to do. We're simply just buying we're shorting those SPY futures, at that particular range, -9 to 1.1. And the way that it works is that in order to keep things in range, because we have a range like that, what we try to do is if on any we let the exposure run, and if on any given day that exposure goes above or beyond that threshold that I mentioned, we will rebalance back to the middle point of that exposure. We'll rebalance back. Now that typically doesn't actually happen all that often, except in very volatile markets like now. And the reason we do that is because if you don't do that, your leverage can get out of control. And essentially the whole point of these funds is to allow investors to invest knowing that they can't lose more than their initial capital. Unlike CFDs and other things where you can receive margin calls or you can lose more than you've put in, these products are not meant to act in that way. They're meant to be exposures that you do not have to worry about getting any margin calls, and they're also exposures for at any given time an investor can come in and know what their existing leverage is and what their existing exposure level is. So that's how those funds are created, the short funds. And if you'd like, I can talk about the long-geared funds as well.
Well, just before we do that,
yeah,
and forgive me if you've partially already explained this, but
yeah.
So the long, just the regular ASX 200 ETF. Let's say the underlying futures go up 1%, then we'd expect that the ETF also goes up 1%. Correct?
Yes, that's right. Yeah. The ASX 200 ETF, that doesn't use futures at all. That just is actually buying the shares. It's actually buying the shares. So there's no futures there. Which is the reason why it will literally go up at that point, less this very small fee that I mentioned before.
Of course. Okay.
Yeah.
So in the case of the inverse ETF or the short ETF,
yes,
the underlying for that, you are short the futures.
That's right.
So if the ASX 200 goes up 1%, then we'd expect the inverse ETF to go down 1%.
Yeah, well, to go down between 0.9 to 1.1%.
Okay. So, but my question is, how do you control that? I mean, sure, you hold the underlying assets, but the price is ultimately governed by traders who are in the market right at that point in time. Like if someone is buying it up or selling it, that's moving the price. How do you make sure that price is in line with the underlying asset?
Well, simply because we are also owning that underlying asset. We're just shorting it. So it's mechanical, isn't it? So if it doesn't matter what the underlying ASX 200 does, if we're shorting that future, then we will provide, a negative version of that, on that day at that particular amount. So if the ASX 200 was to go up, as it has been, sort of go up, sometimes in a very large way, like 5%, because a whole lot of people have been sort of buying Aussie shares, then so too should our ETF be expected to go down by around about 5% on that given day.
But is there a chance that the ETF won't? Like, what if someone is in there and they're doing something crazy and they've, I'm just going to rack my brain to think about which side. Okay, let's say the market is going up, so the short ETF should be coming down.
Yep.
Let's say someone has just got a lot of bids stacked, huge. They could essentially stop the ETF price from moving down 1% to be the direct inverse of what the actual market's doing.
Right. Are you talking about if a whole lot of people are buying, sort of putting a whole lot of bids stacked on the ETF itself?
Yes.
Okay, so that comes back to the fact that buying and selling of the underlying ETF has no impact on the price of the ETF. So that's the important thing to understand. It's not like a company where, if there's a whole lot more buyers than there are sellers, so the price of that company will go up. And that's because of that open-ended nature that I mentioned. So the fact that it's open-ended means that there's there's no relationship between how many people are buying the ETF and the price of that ETF. It is simply the underlying price of the security. In this case, it's a short security, but it really doesn't change the fact. It's that particular underlying security price that's changing the market. You can't game that. You can't game that because these are essentially instruments that are open-ended. So if somebody was to put a crazy price in there, it just simply wouldn't be hit by that market maker. It just couldn't be hit by that market maker. So that's the whole I guess key of an ETF is that it is open-ended, and that open-ended nature means that you can be quite sure that the price of the ETF is not in any way being affected by the buying and selling of the underlying, the buying and selling by individual investors in that price.
Interesting. Okay, I think that answers my question.
Yes,
because it's different to a stock where if someone has a humongous bid at a certain price, then the market's going to struggle to get below that price a little bit until enough sellers are willing to push through it.
Yes, so it doesn't work like that at all. And I said that's because of the fact that it's open-ended, because of the fact those market makers are there, and there's just no way to manipulate that price by using the ETF. Otherwise, it would be one of the easiest games in town, isn't it? So that's the way in which those particular products work.
Gotcha. Okay. Very, very interesting. I'd often wondered about that.
Yeah. So the important thing to understand is that there's open-ended. Again, a lot of investors don't understand that the amount of bids and offers, etc., that you see on the screen, and for that matter, the amount of volume that goes through the ETF on any given day is just the tip of the iceberg. If we wanted to, somebody could go and buy. Essentially, the amount of liquidity in that ETF is only bound by the liquidity of the underlying securities, which in the case of the S&P 500 or the SPY futures is essentially very, very, very close to limitless. So that open-ended nature is the key difference between an ETF and a share. And that really means that, as I said before, those underlying prices are really only focused on the underlying security prices, not the buys and sells.
Okay. Yep. I'm with you.
Right.
Now, when we talk about, you've mentioned it a couple of times, you have like an ETF which will track the NASDAQ 100. How does the NASDAQ 100 ETF, which is provided by Beta Shares, which trades on the Australian market, how does that track the NASDAQ 100 in the US when the hours don't align?
So the thing about the NASDAQ 100, for example, is that there's essentially 24-hour futures prices on the NASDAQ 100. So and this is the case for any international ETF, whether offered by Beta Shares or for that matter, any other group in the world, the way in which the market maker, once again, will set the prices of those international ETFs is by reference to the futures prices, which are live and which still take into account the last day's trading and anything else that comes into people's minds after market in the US. And that's why it can actually sometimes reflect pricing that things that haven't happened yet in the US. For example, if something was released after market, for example. So it's actually quite a straightforward way in which those particular units in ETFs are priced. That doesn't matter no matter which international ETF you're looking at. It will use futures for providing the bid and offer prices to investors.
Right. Just one other thing, actually two more things before we close this out. You often see numbers thrown around in headlines referring to inflows and outflows of ETFs.
Yeah.
Can you just explain that bit, please?
Yeah, so I think people are interested in that because, so what that means, first of all, just to answer your question, what that means is how much, so inflows and outflows really is how much net buying and net selling there are in the ETFs. That's actually the reaction by investors rather than the market movements. So it's independent of the market movement, is how much people are buying this particular product and how much people are selling this particular product in dollars. And that's what inflows and outflows means. And I think the reason why people are quite interested in those is because they can be a really good way to gauge sentiment. For example, if we are seeing, as we are, a whole lot of people buying into our short funds, as I said, that $2 billion in the month of March. That indicates to people, the reason why that's reported a lot is because that indicates to people that there's a fair bit of bearishness around. In many ways, it's one of the best ways to get a view on, at quite a sort of granular level, what people are thinking. So, the same could be said for when we see people reporting that there's been a whole lot of flows into, let's say, the infrastructure sector ETF or the resources sector ETF or a whole lot of outflows in the European ETF. What that essentially tells investors is that, hey, broadly speaking, there's a view out there that is bearish on, for example, Europe, whereas it's, let's say, a whole lot of people are buying, I don't know, healthcare ETFs. Well, that means that healthcare stocks are in vogue. So it's a way that people are increasingly using, because ETFs are becoming to be such a big part of the environment now. They're increasingly using those flows to indicate sentiment and to get a view on what people are thinking in the investing world.
Okay, so that's kind of the main use for understanding that bit, is just to get a bit of a gauge on the market sentiment.
I think market sentiment and also just what's popular and what's not. So I mentioned that there was a whole lot of inflows into Australian shares ETFs in March, whereas before there was a whole lot of inflows into fixed income. So that tells you that there's at least a view out there by some people that it might be worth buying Australian shares, and because it's done in that sort of broad format, rather than sort of thinking about, hey, should I buy BHP or CBA? It sort of indicates that there's a sentiment out there that says there might be an opportunity to buy the dip. So I think that's right what you said. It is largely about sentiment.
Right. Now, just one last question before I let you go. ETFs are often marketed as being a good investment tool. What are some tips for someone who is investing mainly in ETFs for the long term? So I know a lot of the things we've spoken about here kind of relate to trading and sort of more of the technical part. But just for anyone who's also interested in investing for the longer term, might have a 30-year horizon, etc. What are some tips you would give to someone before they, put some money into a few ETFs?
Yeah, well, first of all, the fact that there's so many ETFs, the fact that there's so many types, shapes, sizes, we've spoken about long, we've spoken about short. I should just say that even though most people will view ETFs as great long-term investments, and I think they really are, they are also really interesting ways to trade views, because essentially, given all those things I've mentioned, and I haven't even mentioned half of what's available, there's currency ETFs, et cetera, you can express a huge number of trading views of any sort, whether it's like a relative value trade or whether you're taking a particular sector view into account or a long and short pairs trade. You can do all that via ETFs. We haven't even mentioned the fact that you can take particular sector bets if you wanted to. Let's say you really like the cybersecurity sector or the technology sector, or the gold sector. So you can definitely do a lot of trading. But to get back to your question, you're right that at the heart, the vast majority of people who are getting started in investing look to ETFs as a way to generate long-term wealth. And I think if you're looking to do that, they're obviously a very good way to do that because they're very low cost. And the tips are really to keep things simple. Pick a few building blocks that are typically highly diversified, low in cost, and stick with those and add to those. So if you're in it as a long-term investor and not a trader, then the very opposite applies. You don't want to overtrade. You want to just incorporate broad building blocks for, let's say, global shares, some Australian shares, perhaps adding some bonds for diversification benefits. And with a few easy trades, you'll basically have a highly diversified portfolio right there. Because if you think about it, you'd have 200 stocks in the Australia. You buy a global shares ETF, that could be many, many thousands of ETFs. You add a few bonds in there. All of a sudden, with 3 trades, you might have 12, 1,500 things that you're exposed to. So you're super diversified. And so the tip is to keep it simple like that, add over time wherever possible, and stick with it. So don't let things like the current environment force you to sell. You don't need to be a forced seller. The only people that should be selling right now are those that for some reason need to or are trading it. If you are actually looking to generate long-term wealth, then sticking to it in a simple, low-cost way and adding to it over time is super valuable. And The other way is obviously just make sure that you do things like your DRPs, your distribution reinvestment plan. So every time there's a distribution, you reinvest that rather than taking it out. And over time, you'll generate wealth that way. And finally, it's always good to invest in things you understand as well. And that's why, for example, we've seen a whole lot of people buy things like the NASDAQ because people understand Apple and they understand Amazon and they understand Facebook and they understand Google. So those would be the tips I would say for those people that are long-term investors. Don't get too hung up on short-term fluctuations. Build a core. And then once you've built a nice core, then perhaps you can start playing around on the satellites with more thematic, more esoteric ideas. But the point is you've still got that great core that is growing with you and essentially generating that long-term wealth for yourself.
As you mentioned it, I guess I'd better ask you, trading some relative value types of strategies using ETFs, trading relationships, that sort of thing, are there any ideas you might just want to leave some listeners with? Ideas that they could go away and do their own research? Yeah,
of course. So first of all, you can take a view on a particular sector, just simply. So, if you've got a view that, for example, in today's market, the energy sector, the global energy sector has been way oversold, and you want to take a view on that, you can invest in the global energy ETF. It's called fuel. If you think, on the other hand, that things are still pretty dodgy, you might want to invest in gold, or you might want to invest in the gold miners ETF, the MNRS, the gold miners ETF. We've spoken a lot about taking a view on a downturn using the bear suite of funds, so I don't need to talk about that. We've got currency-oriented funds for those that want to take a view on the Australian dollar versus the US dollar as well, and those are currency-oriented ETFs. Some of them are geared, some of them are not. You can take a view on longer-term secular themes. We see investors interested in themes that really are built for the long term. So we've got, for example, a very popular cybersecurity ETF, HACK, H-A-C-K. That is one where people will say, look, yeah, we're in a tough time at the moment, but cybersecurity is only going to grow and grow and grow. So, that is a thematic trade. So you've got that. Then for those that are a bit more sophisticated, you could take a view using some sort of a pairs trade. An example might be, let's say you really didn't like the look of the Australian share market, but you thought that there was one or two sectors that were really going to stand out. So let's say, for example, you really thought over the long term, you didn't like the banks, you didn't like the mining companies, but you thought those emerging Australian technology companies were going to outdo them all. So the Afterpays or the Appens or those types of organizations. So you could, for example, then, if you felt that way, you could buy a short fund, like the BBOZ fund, and then you could go long the Australian technology sector fund. So you're taking out the market, you're essentially short in the market, but you're going long just the Australian technology sector. Or finally, you could say, listen, I actually, and these are all just hypothetical. You can sort of see where I'm going with these ideas. Is you might say, look, actually, Australia's been oversold relative to the US. The US is actually now bounced back too much. It looks a little bit overvalued relative to where things are at. Whereas the Australian market is still, for example, hypothetically, it still looks like relative value. So then you could go long a leveraged geared fund, and you could go short you could go long a leveraged Australian shares fund, gear, and then you could go long a short US fund, which is BBOS. So essentially, that's a relative value play on Australia versus the US that way. So those are some examples that, of course, are highly hypothetical. You need to do your own research, but those are some of the things that we see people doing.
Of course. But yeah, there's certainly so many opportunities for different ways that you can get creative about how you want to express your ideas with ETFs, and do it all with, just a couple of trades too.
Yeah.
Ilan, well, I've thoroughly enjoyed having this conversation with you. Thank you very much for coming on the podcast. I'm sure there'll be some people listening to this who would like to follow along with you. Maybe Twitter is the best place to do so?
Yeah, Twitter, BetaShares is on Twitter. I'm on Twitter as well. We're obviously on LinkedIn and we're on Facebook. So we're everywhere, Aaron. So anyone who wants to get a hold of us, they can. And of course, our website, betashares.com.au, easier to find.
And your Twitter handle is?
Ilan, ILAN _ high.
All right, we'll leave it there. Until next time, thank you very much, Ilan. We'll chat soon.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.